No one said fighting inflation was going to be easy. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to closing bell here in the U.S. You're looking at a rally. It's a small rally, but a rally nonetheless. You look at the S&P 500 building on its recent gains, up about 0.3%. Big tech doing even better. The NASDAQ 100 up by about 0.5% at this moment. You take a look at the bond rally resuming in the wake of those inflation figures that we got at 8:30 a.m. this morning, down about 3 basis points right now on your 10-year yield. We're looking at 420. And I want to highlight chips really briefly here, Romaine. Of course, we know that chips have been on fire recently, and that's continuing today, tepid, but still another 0.6% gain.
Yeah, we're going to get to that a little bit later. But of course, we have to start off with the talk about inflation. And of course, the U.S. inflation data this morning, well, it had to have been a bit of a disappointment for some of the folks out there, particularly those who were betting that the Fed's restrictive policy stance was finally starting to loosen. Now, while the deflationary trend in core goods prices did extend for a 6th straight month, inflationary pressures in the services sector, that still lingers. And shelter prices, which make up about 1/3 of the overall CPI index, and remember, are key to bringing core inflation down, that number re-accelerated on a month-to-month basis. Now, consumer prices overall, that headline CPI number, that's at 3.1%. That's 1/3 of where we were, about a year and a half ago. But 3.1 is not 2.0 last time I checked, which is a target the Fed remains committed to hitting. U.S. Treasury Secretary Janet Yellen, a former Fed chief herself, said Tuesday she doesn't believe the last mile in returning inflation to the Fed's target will be especially difficult, though she did decline to offer any advice on how the central bank should actually finish that job. Now, her successor at the Fed, Jay Powell, has repeatedly pushed back against growing bets of rate cuts early next year. And 3 of the most accurate U.S. bond forecasters of 2023, they actually seem to be taking his side, Katie. They say traders who have propelled bond prices lower and yields higher, they're falling into the same old trap that they fell into a year ago and 2 years before that, which was betting against economic strength and the likely persistence of inflation.
Well, it's not just bond traders, too. You can see that reflected in some of the survey-based results of inflation expectations. You take a look at 1 year ahead inflation expectations. That's at about 3.4%. While, of course, that is higher than where we were pre-pandemic. You think about the fact that we were above 6% in 2022, and clearly a win for the Fed that cares very deeply about those inflation expectations. What maybe isn't a win for the Fed here, you take a look at financial conditions, as Romaine mentioned, pushing back against those rate cuts getting priced in, pushing back against financial conditions easing, but that's exactly what they've been doing. You can see we turned negative earlier in the year into tighter territory, but taking a look at these market-based measures of financial conditions, we've been easing, and easing pretty significantly, Romaine.
That CPI report, of course, the backdrop for the start of the 2-day Fed meeting, a big decision and a big communication decision tomorrow, Wednesday. Let's get down to Bloomberg International economics and policy correspondent Michael McKee down in Washington. And Mike, we got to start off with that CPI report. The numbers themselves, I guess they weren't bad, but they certainly didn't ratify or even explain, I guess, that downtrend that most people seem to think is still in the cards.
A lot of people thought that it would be a much faster drop because we've seen a relatively quick drop in inflation over the last 12 months or so. But Jay Powell and his colleagues on the Fed have warned it's going to be lumpy. We're going to have months where inflation seems to rise a little bit. And that's going to be coming up at the beginning of the year as well, because we had some very low inflation readings in 2023, January, February. So those will push up inflation in those months coming up in 2024. So if you're betting on the Fed cutting rates early, you've got to be betting on some sort of quick event into a recession situation, because I'm sure Jay Powell will push back tomorrow.
And when it comes to pushback from Jerome Powell, of course, there's been a lot of talk about him potentially pushing back against financial conditions, against the easing that you've seen. Then you talk to the other camp and they say it's not too big of an issue for the Fed. What's the current consensus, though, on that big easing that we've seen in those financial conditions?
Well, most of it seems to be coming from the stock market and the fact that equity investors are quite happy with the way things have worked out, and the fact that their discount rates have dropped along with bond yields. But when you look at the actual transmission of monetary policy into the economy, while mortgage rates have dropped, they're only dropping from 8% to around 7%. And auto loan rates and credit card rates haven't fallen at all. So it's not necessarily that the overall economy is seeing looser credit. Credit's staying about as tight as it was, but it does help the financial markets. And that's what's showing up in those financial conditions indexes.
All right, Mike, great to chat with you. As always, our thanks to Michael McKay. And for more market analysis, we're joined now by Sonia Meskin. She is head of U.S. macro over at Bank of New York Mellon, joining us on set. And let's start there. At 8:30 a.m. today, obviously, we got those inflation figures. Some would say that this is really showing that the Fed's policies are working. This is more fuel that they can stay pat, that this tightening cycle is over. What's your read, though, on how this might affect what Jerome Powell we get at 2:30 p.m. tomorrow?
Sure. I think they should be quite happy with these developments. Some of these are probably attributable to their policy. Others are probably more exogenous, such as, what's happening in the goods market, for example. We know very well it's a global market. China has overproduced, and it's helping bring inflation down here as well. Services has been stickier, but I think they've expected that. And I do think that tomorrow, Chair Powell will allude to both of those factors.
And it feels like the narrative, don't fight the Fed, has come back into the market psyche right now. You think about all these rate cuts that are getting priced in next year. You think about the messaging from the Fed pushing back against that. How big of a problem, though, is it really for the Fed that we have all these rate cuts priced in?
Listen, the markets really vacillated this year in terms of how many cuts and even how many more hikes initially we were going to get. So I think the Fed has come to terms with that as well. I think they want to leave some optionality, and that will also transpire tomorrow. They're probably quite happy with the fact that financial markets are doing well, relatively orderly functioning, and they can wait and see how sticky inflation will remain in 2024. We know that Chair Powell told us earlier this year that they don't anticipate cutting until the second half of 2024. I would be very surprised if he pushes against that tomorrow. But I do think he's going to want to leave some optionality.
Let's talk about those cuts, though, and sort of what those cuts actually mean. Because some people think they hear Fed cuts and they immediately think, okay, it must be because of bad economic conditions. Is there a case to be made that with the Fed funds rate still at 5.5%, at least the top bound of that, and now you have Treasury rates that are around 4.5%, and you have an inflation rate on pick whatever metric you want, core, headline, whatever, that is firmly below 5.5%, shouldn't rates now start to come down?
Well, yes, I think that that's precisely the point that they would want to make tomorrow, that if they do, when they do bring rates down, it would be because they don't want to be overly restrictive. It is not because they anticipate an imminent recession next year. So it would be for the reason of, not keeping financial conditions too tight.
This gets to the point, though, of timing. And we know the Fed got a lot of criticism for starting the rate hiking cycle too late. And now I think there is some fear that they may stay too restrictive for too long.
That's right. And I think they're aware of that fear, but they also would want to see how, given the very strong labor market, we had very strong numbers last week, right? We had a participation rate that went up just as unemployment went down. So technically speaking, we don't exactly know what the shape of the so-called Phillips curve is, but there is some potential there that inflation might as well accelerate.
But I mean, even when you look at the Phillips curve, and I mean, Dudley has kind of talked about, Bill Dudley has talked about this a lot on this program here, and then you look at the strength in the labor market data. Is that not the soft landing, or at least the makings of a soft landing that Powell, I don't know, however many months ago, basically said he was targeting?
It could be. The so-called sacrifice ratio, how much unemployment needs to go up for inflation to come down, has been lower so far than I think had been feared.
Sonia, let's bring this to the markets because especially, we had a few bumpy months in the summer, but it feels like stocks have found a way to rally no matter what. And let's say we get into 2024, the Fed does start delivering those rate cuts. Is that just a green light for risk assets? How are you thinking about this?
All else equal, it should help smaller companies that are not as tech-driven, that are not necessarily driven by this AI euphoria, right? And that have really been hurting due to higher rates. So actually, I think that combined with higher real disposable income, all else equal, it does increase the probability of a soft landing.
Sonia, always great to talk to you.
Same.
Sonia Meskin, head of U.S. Macro over at Bank of New York Mellon, helping to kick us off to the close here On this Tuesday afternoon, coming up, a conversation with the CEO and CIO over at Strive Asset Management. The company recently crossing the $1 billion mark in assets under management, and that's just 1 year after the launch of its first fund.
Plus, we'll speak with David Hunt, the president and CEO of PGIM, and get his macroeconomic outlook for the year ahead. And the future of soccer here in the United States. Dan Hunt, president of FC Dallas. He's also chairman of FIFA World Cup efforts for the city of Dallas in 2026. We're going to have to hear what he has to say about progress being made in the world's biggest sport, in the world's biggest market. That's coming up next on The Close on Bloomberg. Well, our next guest heads up an investment firm that now has more than $1 billion in assets under management. That's a little more than a year after the launch of its first exchange-traded fund. Joining us now, I'm pleased to say we have Matt Cole. He is the CEO and CIO of Strive Asset Management. Matt, it's great to have you on set with us. And of course, Strive, founded by presidential candidate Vivek Ramaswamy. And I gotta say, I follow you on LinkedIn. I know that Strive tends to push back against the anti-ESG label, but a lot of people would look at what you're doing and say that sounds pretty in opposition to ESG to me, trying to basically accumulate enough assets to have a say in the boardroom. Why are you pushing back against the anti-ESG label?
Yeah, it's just the wrong framing. So let me actually frame it how we frame it at Strive. And so you have to first actually go upstream. And the upstream question that you have to ask is, what is the purpose of a for-profit corporation? Our belief is to maximize value to shareholders unapologetically. And what that means is that the shareholder is the most important stakeholder. And that's actually a contrarian view today in U.S. asset management, where most asset managers, large ones, have actually pledged to support stakeholder capitalism, which is effectively European capitalism. Call it all stakeholders, customers, employees, governments, shareholders are all equally important. It's deprioritized the shareholder. We reject that. And so we say the shareholder is the most important stakeholder. Downstream of that is how you think about E, S, and G issues, which we have actually opinions on. We're not anti-considering them. We actually have tangible just views on those different risk factors.
So how do you get big enough to actually have sway, though? Because looking at recent articles about Strive, you have seen fantastic growth for a new ETF issuer, $1 billion in assets under management, no small feat. But you think about owning a very, very small percentage of a stock. How do you actually attract enough fish to make these companies listen to you?
There's really a couple different prongs that matter here. One, it's what is the argument that you are taking, whether you have one share or whether you have millions of shares. So if you bring an argument that actually the C-suite and the board agrees would add value to shareholders, they're sympathetic to that. And then secondarily, what we've seen is that a lot of the boards and C-suites have actually been in opposition of how these large asset managers have pushed change on them. And so when we come and bring a different voice, for a lot of corporate America, that's actually a welcomed voice.
And let's talk about the rest of your lineup, though, because I hear that message, but then you take a look. I know that you've recently launched a short duration bond ETF, for example. Is that moving away just from that brand of activism that you're doing, or how does that factor in?
So we're about maximizing value to our clients, period, in any different market that we can touch. So whether it's public equities, whether it's fixed income, whether maybe at some point it's the private markets, it's value maximization. And in index funds particularly, the way we maximize values through our vote and our voice, the G, and through fixed income, it's just what's the best bond to buy, period. And that's my background. I used to manage $70 billion at CalPERS.
So, yeah, that's right, and I'm glad you brought that up. Talk to us about the growth, though. I mean, we mentioned that this has basically gone to $1 billion in barely a year's time, and really, even if you just look over the last couple of months here, yes, hundreds of millions added here onto assets under management. Where is that money coming from? Who are the people who have, I guess, been receptive to these products?
Yeah, so lately it's been advisors, financial advisors, wealth managers across the country that are staking their business to Strive, allocating Strive's ETFs to all of their clients. Day one, it was different. It was actually everyday citizens buying our products, buying our ETFs at $1,000 a clip, very small trades. Today, it's actually advisors that think it's both part of their fiduciary duty to maximize value to shareholders, but also, frankly, just a good business decision to unapologetically support American capitalism and American exceptionalism. It actually differentiates themselves in a very crowded market.
So when we talk about the strategy of using the RIAs, was that a deliberate strategy the Strive chose to take, or did that just kind of happen organically?
So our strategy day one was actually to appeal to all potential clients, everyday Americans, advisors, institutions. And frankly, I think that when you start at the smallest level, the everyday citizen, it's the easiest capital to move. And as you go up the chain, the bigger pools of capital take longer, take track records and stuff like that. So I think it's just showing growth of our company as we've now hit everyday citizens, and we also hit wealth management.
And Matt, I'm sure you can appreciate that it's impossible to have a conversation about Strive without talking about Vivek, who of course was one of the co-founders of Strive. He's since stepped down as CEO. What is his current involvement with Strive, though? Does he have any decision-making capacity when it comes to Strive?
He's still a shareholder of Strive. He's not involved in the day-to-day decisions. So he used to be the executive chairman. He's on the board. He no longer is because he's running for president, and that keeps him pretty busy, as I'm sure you can imagine.
And looking forward to the future, let's say that the presidential bid fails, he doesn't become president. Would he come back to Strive?
I don't know what was in his mind. All I know is he's one of the smartest people in the country, and if he wanted to, that'd be great, but we're doing our path regardless.
All right, Matt. Well, it's really great to speak with you. Appreciate you stopping by. That is Matt Cole. He is CEO and CIO of Strive Asset Management. Now coming up, Ford slashes its electric F-150 production goals for next year by half. We'll discuss why and what it could signal for broader demand next. This is The Close on Bloomberg.
Wednesday, the Fed decides.
We're talking rates, we're talking inflation.
Without a recession, that's the good stuff.
Will officials pause as expected?
We're heading into the end of the year. We're in a soft landing right now.
Will they put rate cuts on the table for 2024?
It remains to be seen. The data will dictate that.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Everything was hedged.
They're going to have a good reason to do whatever.
Bloomberg surveillance. The Fed decides. Wednesday on Bloomberg.
Over the last few hours, we've learned that Ford is going to cut its 2024 production goals in half for its signature electric vehicle, the F-150 Lightning plug-in pickup truck. It cited slowing demand for battery-powered models and raised some other questions here about the company's strategy in the EV space going forward. Bloomberg Autos reporter Keith Naughton joining us right now from Detroit to talk a little bit more about this. And it's not just the F-150 Lightning, but it looks like a scale back in the Mach-E and some of these other models. I mean, there was a lot of press, a lot of ink spilled when they first announced these models, and there were a lot of high hopes. What's going on?
Yeah, there's a big retrenchment going on at Ford, Romaine, when it comes to electric vehicles. They're deferring $12 billion in spending on EVs. They just shrunk the size of a battery plant they're building in Michigan by almost half. And they have now cut the F-150 Lightning production in half. And that really was the vehicle that was supposed to lead Ford into the electric future. And right now, it's like all EVs out there becoming a harder sell. The growth rates have really plunged in terms of sales growth for electric vehicles. Consumers are pushing back on high prices. They're worried about spotty charging infrastructure. They're just worried about the convenience or lack thereof of owning an electric vehicle.
Well, Keith, this story was interesting to me for a number of reasons. One of them being that the Lightning, by my understanding, is pretty popular. And you note in your reporting that the Lightning had its best sales month ever in November. So it seems like maybe that just isn't enough, though.
Yeah, I mean, it did have a good sales month, but it was about 4,400 that they sold in November, just to sort of balance that against the gas-fueled version of the F-150. They sell about 600,000 of those a year. So it's still a very small portion of F-Series sales. they obviously hope it to be much larger.
I do, but I want to hit on a finer point here about demand. Is this really about people don't want EVs, or they're just not comfortable in kind of the charging infrastructure and some of the things that come along with owning an EV? Because it seems like when you see polls out there, consumer polls, it seems like most people are interested in these vehicles.
Yeah, Romaine, I think sentiment has switched a little bit. I think what's happened is those early adopters, bought electric vehicles because they wanted the latest and the greatest. Now we're getting to kind of the mainstream buyers. They're more pragmatic, and they're kind of giving a rethink to the whole EV experience. Hybrid sales are starting to go through the roof. So people are, instead of getting the full battery electric, they're going hybrid as a way to reduce their carbon
isn't
footprint.
I mean, I don't mean to be too argumentative about this, but as somebody who was in the market for one of these things, first of all, you couldn't even get your hands on some of these EVs. And you know what we did as a family, Keith? We started looking at hybrids. So I wonder, is this just kind of Ford and some of these other EV makers kind of doing themselves in by not meeting the demand when they had it?
Well, so now what's happening, Romaine, as you've probably seen, is inventories on dealer lots are just ballooning with EVs. It takes 50 days to turn an EV sale on a dealer's lots these days, which is above the industry standard and way above where hybrids are going. So the hybrids are flying off the lot. Electric vehicles not as much.
Okay, so maybe I should go buy one now, and they won't have like a $12,000 markup on it.
Yeah, there you go. Well, let's broaden out the EV conversation a little bit and talk about Lucid. We should note that earlier Bloomberg Television showed a graphic that incorrectly said that the Lucid CEO stepped down, but it was in fact the CFO. Keith, what does this departure mean for Lucid?
Yeah, so Sherry House, she came from Waymo a few years ago, the self-driving car unit of Alphabet, Google. And she was not there for very long. It's been a tough year for Lucid. They've missed a lot of production targets. They scaled back again last month. So they're really just trying to get their Lucid Air to be a legitimate competitor to Tesla. And, Tesla is a formidable competitor. It's rough going.
All right, Keith, this is an interesting story to me, and I think at some point we have to have a longer conversation with you about the infrastructure side of this, because I feel like that plays a big factor in it as well here, but at least if you're not buying, a Tesla. Keith Naughton, our man in Detroit, covering all this for us, the latest news out of Ford, a bit of a scale back on some of their EV ambitions, that they kind of, Katie, ratchet down some of those production plans. And I know you were kind of in the market for a car at one point as well, and I kind of wonder, there was nothing really to be found for a while, and now Keith is telling me if I go back out to a lot, apparently I could find something.
Yeah, I got to say, when we started looking for a car, we're still looking. EVs didn't even enter the conversation. I mean, you think about range anxiety, you think about the cost.
Are you anti-ESG too?
I'm not anti-ESG, but I feel like maybe I'll give it 10 years or so, maybe let some of those models mature.
Well, in fairness, you do have a horse, which is like
that's true.
That's pretty fuel efficient, right?
Yeah, exactly.
All right, that's good for the environment. Stick with us. A lot more coming up after the break. This is The Close on Bloomberg. This is the countdown to the close, almost 2:30 here in New York. Let's get a check of what's going on in the commodity space as we await settlement right now of NYMEX crude futures. NYMEX crude futures that are down once again, in fact, hitting some of the lowest levels that we've seen in about 5.5, almost 6 months. You see it there, a downdraft of about 4% here on the day, 68.61 here on your screen. And we should point out now, we are moving deeper into contango with those front month contracts now dipping significantly below the longer dated ones as well. However, on the inflation front, this does actually prove to be a good sign, at least if you are filling up your gas tank. You take a look at gasoline prices there, second line of your screen here, and they continue to move lower. And that is exactly, I think, what Jay Powell and the Fed wants to see here. Gasoline futures, remember, peaked back in June of 2022 at about $4.27 a gallon. They've fallen by more than half. And today, just taking a look at there, at $1.97, this would be the first settlement below $2 a barrel since late 2021. Natural gas futures also continue to move lower here on the back of warmer weather in the U.S. and wheat futures climbing higher right now. That's on the back of concerns here that the wheat harvest in Europe is going to be a lot smaller than what some folks had planned for. All right, we do want to stay in the commodities space and stick with oil and a really troubling development that's been going on off the coast of Guyana. Guyana's president says oil majors are moving ahead ahead with production plans in those countries' waters. Remember, that is the latest and probably the biggest oil find that we've had in several years anywhere across the globe. But there is a huge border conflict with neighboring Venezuela as to exactly whose waters those are. We heard from the president a little bit earlier.
But as it relates to Exxon and all the members of the consortium, they are moving ahead aggressively with their production plan. All the exploration in this region, Essequibo region, will continue. All our investments, both at the public and private level, will continue. There's absolutely no slowing down. There's absolutely no slow or no holding back in the investments that we have for Essequibo, as we have for the other 9 administrative regions and the other 2 counties of Guyana.
Irfan Ali, the head of Guyana, speaking a little bit earlier. President Nicolas Maduro of Venezuela last week telling ExxonMobil and other oil majors to leave the region within 3 months and raising the possibility of armed confrontation. Kevin Crowley of Bloomberg are in our Houston bureau joining us right now to talk a little bit more about this. And Kevin, when this came up on my radar about 2 or 3 weeks ago, it kind of seemed kind of fantastical. I didn't even realize that we were kind of on the verge of armed conflict over there. How serious is there? I know there's a lot of dispute over who owns these waters, but are we really at the stage of armed conflict over settling them?
We're not quite there yet, but there's been a serious escalation in tensions over the last couple of weeks. Now, this is a conflict that goes back more than 100 years to the colonial period, the British and the Spanish in the 1800s. But it lay dormant for many years, and really just in the last few weeks, Venezuela has had a lot of saber rattling over this region of Guyana. Earlier this month, they held a referendum in which the people voted that Essequibo, which represents about 2/3 of Guyana, it's a big chunk of the country, actually should belong to Venezuela. There's been various rumors on social media about things going on the border. We haven't heard anything really factual to back that up yet. But there's certainly the war of words is really escalated to a worrying level over the last few weeks.
And Kevin, we know that we have a meeting coming up between Guyana's president and Venezuela's president on Thursday. What are we expecting out of that?
Well, this is, yes, the Guyana President Irfan Ali and President Nicolas Maduro of Venezuela are meeting in the Caribbean island of St. Vincent on Thursday. It's kind of neutral territory, and this is an attempt to somewhat de-escalate tensions. We're not sure what really is going to come out of that, but the fact that there is a meeting and that they are talking is seen as a positive sign as opposed to any kind of military conflict.
All right, Kevin, really appreciate your reporting. That is Bloomberg's Kevin Crowley. Now, we do want to bring you some breaking news. This on Netflix. The streaming giant just released viewer data on every single show and movie on its service. Bloomberg's Lucas Shaw broke the story, and he joins us now from LA. And Lucas, it seems like a lot of people were watching The Night Agent.
Yeah, it was the most watched show in the first 6 months of this year. Now, the thing to remember, of course, is that there are a lot of ways to measure viewership on Netflix. It was the most watched season. It was not the most watched show. If you add together all seasons, that would be Ginny and Georgia. Another Netflix original, and Netflix has clearly gotten to the point where it is so big and commands so much viewership that after years of not wanting to disclose anything for competitive reasons, it now feels very comfortable sharing because it makes it look really good.
Yeah, I am curious about the comparisons here. I mean, when we talk about number of hours watched, I mean, does that mean that this skews more towards things that are series that have multiple episodes versus, say, just a one-off movie that's just 2 hours, or are they accounting for those differences?
It does skew towards television series. So in the weekly top 10 list that Netflix puts out, it has started to offer both the time viewed and the total viewers, which should account for the fact that the average movie is maybe 2 hours and the average TV show in the English language, at least Netflix told us earlier today, was 9 hours. On this data dump, which they're now going to do twice a year, it does mean that TV shows chart much higher than movies. I think the highest movie is like number 20 or something on the list.
And Lucas, as you said, Netflix coming out with these numbers in a large part because it makes Netflix look good. Could we see other streamers take a page from their book and release their own numbers?
I would be surprised if we saw other services release at this granular level. what they have started to do, really just Disney, I want to say, is Disney will give kind of like a not so real number of people who've started or watched something on a given weekend, which is sort of how Netflix started 5 or 6 years ago. If you remember the movie Bird Box, that was one of the first titles where Netflix gave any kind of viewership figures. The Netflix executives were asked about this on a call with press earlier today. And they said, look, we're farther along in our journey than some of these other companies. I think it's reasonable to expect that companies like Disney, HBO will do so longer term. But because their viewership is so much smaller than Netflix, they don't have a lot of incentive to do so right now.
Night Agent, Ginny and Georgia, The Glory, Wednesday, and Queen Charlotte are Bridgerton's story. Which one is your favorite, Lucas?
I didn't watch most of those, so I'm gonna go with The Glory because it's the only one I even watched a couple episodes of. Wednesday was great, I'll say that.
All right, well, you're one more than me here because I've watched absolutely zero of these. Lucas Shaw, our man out there in Los Angeles, a pretty big development here for Netflix, now releasing more concrete data on just what people are watching and how long they're watching it. We'll come back to that story a little bit later in the program, I'm sure, but up ahead, a focus on Adobe, the owner of Creative Cloud. It reports earnings tomorrow after the closing bell, and investors today, they're looking to find out just how much that company is adopting AI into its programs. We'll preview next. This is The Close on Bloomberg. All right, let's get right to our top calls. The big movers on the back of analyst recommendations. And we start off with Macy's. A downgrade to sell over at Citi with the analysts skeptical of that $5.8 billion buyout offer from Arkhouse and Brigade. Says it might never be consummated. The analyst says unlocking the department store chain's real estate value, that's easier said than done. And he adds that in the high interest rate environment, trying to finance this deal might be too difficult to even complete. Those shares down 7% here on the day. Next up, let's take a look at Airbnb, which got cut to underweight from equal weight over at Barclays. Data the analyst cites unveiled a plateau in short-term rental demand. And he says with increased competition from hotels picking up, they're cautious about Airbnb's trajectory in 2024. Those shares down 1% here on the day. Finally, Zscaler, an upgrade to outperform from neutral over by the analysts at Macquarie. The new price target is now $231, with the analyst saying Zscaler sits at the nexus of the demand tailwinds from cyber threats and the new SEC requirements for reporting data breaches, and that sets the company up for long-term durable growth. Those shares having a decent day, up by about 2.3%, and those are some of our top calls. Staying in the tech space, staying in the software space, Adobe set to report quarterly results tomorrow afternoon. Let's get a preview of what to expect with Michael Turrin, senior analyst over at Wells Fargo, joining us right now. And Michael, I guess this is either going to be a story about, I don't know, recurring revenue from subscriptions, or it's going to be about AI, or it's going to be, I guess, about an amalgamation of both.
Yeah, we think it's going to be an amalgamation of both. It's been a tale of 2 years for Adobe. 2022, the stock was down 40%. This year to date, the stock's up nearly 90%. A couple of key points in question. Certainly, Adobe's competitive positioning with AI and the Firefly product, which I'm sure we'll talk some about. And a lot of this is tied to how the company framed targets, which is why Q4 is so important. We're looking for guidance for the coming year in 2024, and that's an important milestone for the company.
I am curious, particularly with AI and Firefly. I mean, as an Adobe user, I've now finally started to see these things kind of push my way. I have not necessarily used them, although I'm not really a power user, probably not their core audience. I am curious about adoption so far. I know it's still early, but what do you think we're going to see?
Yeah, I mean, we were at the Max conference in Los Angeles in October, and the feedback was universally tremendous. Creative designers think this, 80% of creative professionals think this will save them a significant amount of time, and we're talking 20 to 25% of their work week back. If you think about what generative AI does, it's effectively helping you become a power user. So you no longer need to know all the different menus and drag and drops to get to something super specific within Adobe. You can use natural language to type and find that.
And
that's where Firefly.
Adobe. I mean, anyone knows the learning curve for something.
Yeah, exactly. And so the Express product, which is kind of their lower front-end product that was made to go after the more general-purpose business user, those monthly active users are up 20% just from last quarter to the current quarter.
Yeah.
So you're seeing tremendous traction. I think it's helped Adobe unlock a new user base that they weren't previously able to unlock.
And zooming out from just AI, let's talk a little bit about the Figma acquisition. I guess I have two questions for you.
Yep.
One, is it ever going to close? And two, do you want it to close?
So we think it's going to close. And we want it to close, but we are in the minority relative to investors that we speak with. A couple of things to consider. The price of the transaction has changed. Half of it was $10 billion in cash, half of it was $10 billion in Adobe stock, which was below $400 when the deal was initially announced. So Adobe's success has kind of driven a different price point. That's led investors to push back on the multiple that Adobe's paying. And I think what also has changed is when Adobe made this acquisition, there were a lot of questions around competitive positioning and concerns around some of the upstarts that were starting to make noise in the digital media space. And so Adobe purchasing Figma at that point in time kind of warded off a competitive threat. But now that we're talking about AI and Firefly, I think there's viewed as less need or urgent need for them to defend their moats because they have an AI-enabled product. And what we've seen from Adobe time and again is a new medium is a new lifeline for the company. If you think about the advent of cloud computing, the advent of mobile, now the advent of AI, these are things that just become monetizable for a company that has hundreds of millions of users.
Yeah, absolutely. All right, Michael, this is a great conversation. I'm glad you could join us on set from California. Michael Turrin over at Wells Fargo, a preview of Adobe. Those earnings scheduled to report tomorrow after the bell. The street looking for roughly about 4.14 on that adjusted EPS number on the back of $5 billion in total revenue. Coming up here on the program, Michael Polsky going to be joining us to talk a little bit more about what he sees as the biggest hurdle to support the push to renewable energy. That conversation coming up next. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joins us, as he does every day at this time, with a conversation today, I'm told, about renewable energy.
Yeah, it seems timely, given the fact that COP28 is just wrapping up. We spend a lot of time talking about wind farms, talking about solar panels, things like that. The thing we don't talk about very much is the grid and the transmission system. And when you talk to some officials, they say that's actually where the vulnerability lies, that we have a lot of problems actually delivering all this energy if we can generate it. And somebody who really specializes in that part of it, in the delivering of it, is Michael Polsky. He's Invenergy founder and CEO. Invenergy is the largest privately held renewable energy company in North America. So, Michael, thank you so much for being with us. Give us your sense of where we are in the move to renewables. We've got some ambitious goals here, but talk about the transmission capability of the grid.
Yeah, fortunately, we have very ambitious goals, but we have one problem, is electrical grid. Our grid has been designed years ago. It's morally old. In other words, it was designed for a different type of generation that we have now. It was designed for large, huge power plants located in certain areas. And as we go through energy transition, our grid is not really supportive of this kind of expansion. In addition, we have load growth, so our grid has also become too small to support what we have going right now. So I believe that our energy goals probably will not be met unless we make major expansion investment in the electrical grid.
So, Michael, we hear a lot about what's coming out of Washington. A lot of money's been appropriated to really move into green. Is there money in there for the grid? Is there enough money? And how can we get this grid expanded, developed in the ways that you think we need to?
I like to use this comparison, David. I like to say, if you want to deliver something, you may buy a lot of trucks, but if you don't build the road, you're not going to get things brought to the end use here. Same with the electrical grid. We appropriated a lot of money to build generation, but we did not appropriate either money or we not change our regulatory process to build the electrical grid to deliver that electricity that will be generated to where the consumption is. So I think this is our major bottleneck, and unless and until we address this, our goals as I said before, will not be met. I could give you some example. For example, now we have a lot of renewables being built in areas where there were no grid or very little, sort of call it very small grid or weak grid. And in order to interconnect this, we have to build stronger lines. In addition, with renewable generation, right, it's a weather-dependent resource. So you have to really connect a large geographical area in order to get reliability and resiliency that you expect from all the generation and associated grid. And if we would not do that, we will not achieve our goals. We will still be vulnerable to hurricanes, to the weather disruption, to other calamities that will sort of, interrupt our power supply and create a havoc among general public.
Is there a part of this country where you feel that could be done as a test case? I mean, where is this amenable right now?
I think it's a generic problem for the whole country. We don't have a system. We don't have a planning. We have regional transmission organization, they call, but they also kind of insular to themselves. They don't want to really interconnect larger geographies. For example, my company, Invenergy, we developing one of the largest transmission line in the United States, 840 miles from southwest Kansas to the eastern part of the United States. We basically connecting 3 RTOs, and we also bring 5 gigawatts of renewables almost around the clock. And the problems are that we don't have a central policy how to do this, who pays for this. For example, even the remarkable part, we don't have a system that value reliability. If something adds to reliability, there is no value. We don't know how to calculate this and how to pay for this, and that creates additional problems. So I don't want to sound like alarmist, but I want to tell you again that we will not achieve our renewable goals or energy transition as we expect without investing substantial resources in the grid and actually building a grid, not just talking about the grid, but actually building it.
Have you brought this message to the folks in Washington, the lawmakers, the regulators, and of course the folks in the White House?
I have. As a matter of fact, there is an organization called government entity called Federal Energy Regulatory Commission that's responsible for those issues. We have a number of open dockets we ask them to rule on, but unfortunately, we don't hear much. So nobody wants to tackle very difficult problems, and it is a difficult problem. But how we can, but like I said, if we don't tackle problems, we'll still be talking, about this for next 20 years. I just want to give you one comment here. For example, in Europe, particularly after war in Ukraine, Europe decided to really diminish their reliance to Russian natural gas and oil as well. And electrical grid is built out as a part of the government effort here. So there is no discussion. They just invest and they're doing it. In the United States, it's strictly private sector responsibility. And like I said, we don't have really factors that will promote that. I mean, we have to create enablers that let private sector to build the grid, and we don't have it. So the only grid being built a little here and there is so-called regulated company, and they recover it through their normal regulatory process. But those are normally small lines here and there. They're not interregional lines. They're not lines that really help energy transition big time.
Michael, just very briefly at the end, just locally here in New York, what about that big project for the wind farms up north in the northern part of the state to bring us to New York City? I know you're a partner in that. Are we going to get it done?
We hope we're going to get it done. Obviously, as always, we have issues as well, and we hope we can go through those issues and get it done. I think New York State is very supportive. We hope to get done, but again, I always like to say it takes a village to get big transmission project to get done, and this village has to come together.
Okay, Michael, thank you so much. This is a perspective we really haven't heard enough of. That's Michael Polsky. He is Invenergy founder and CEO. So there's a lot to be done, obviously, with the grid, and we don't hear about that because it's not the sexy part.
Yeah, it's not the sexy part, but I think he gets to the heart of the issue, too. If you don't have sort of a top-down, sort of a centralized approach to this, it's just not going to get done.
Exactly, and you got all the states in addition. They also have regulatory authority, so it's
Good luck.
It's not easy. Exactly, good luck is exactly right. So on Friday on Wall Street Week, we're going to be joined by Rick Reeder, BlackRock's CIO of Global Fixed Income, and he, as you know, is managing an ETF. We're going to talk about how that is working. That's coming up Friday at 6 p.m. New York time.
And, of course, you can catch David Weston every day around this time right here on The Close for our Wall Street Week Daily segment. As we round out here the first hour of the show, we head into the final hour of trading here on this Tuesday afternoon. The economic data is here, and now we just await to hear from Jay Powell and company tomorrow afternoon. The market's taking it in stride here, modest gains in equities and a mixed bag going on right now in treasuries. But keep an eye on what commodities are telling, because they're telling a completely different story. Full breakdown of all the market action coming up after the break. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick.
And I'm Katie Greifeld.
Interesting market day once again here. I don't know if people were expecting sort of a big takeoff once we got that CPI report, or maybe a big draft down here, but we kind of got neither here. I mean, stocks are in the green here on the day, but once again, the gains are fractional.
Fractional, muted day. We've been really building upon tepid day, but of course that narrative could change pretty dramatically tomorrow when we hear from the Fed, not only getting the decision, we get the dot plot, and we hear from Jerome Powell. Until then, it kind of feels like a holding pattern.
Yeah, absolutely. A bit of a holding pattern. You can see Bitcoin also in a bit of a holding pattern after breaching that 44,000 level a few days ago. Flip up the board here, because I do want to take a quick look at what's been going on with crude oil here. We have another downdraft. Remember, we're basically, something like 7 weeks into this decline here, and there really doesn't seem to be any sort of let up. And one thing that's always a big tell here, of course, is when you get that differential between the front month contracts and those longer term contracts, basically what is now contango, where that short term contract is cheaper than the longer term, which seems to suggest that at least people in the here and now don't have a whole lot of confidence in economic conditions, or at least in industrial conditions that will be reliant on crude oil.
Yeah, a much different message than what's filtering through the stock market. But let's talk about some of the individual movers today, because we have quite a few of them. We have to talk about Hasbro. Of course, this is the maker of Dungeons & Dragons, My Little Pony. Romaine, I'm sure that you are familiar with those names. But the big news here is that they're cutting 1,100 jobs over the next 18 to 24 months. That amounts to about 20% of the workforce. But the real thing here that is attracting a lot of interest is that this was announced 2 weeks before Christmas. We know that they had been struggling with the softer toy industry. They, downgraded their outlook back in October. Clearly, those issues are still there.
I'm a little confused. You picked Dungeons and Dragons and what was that? My Little Pony. You forget what? I mean, they got Power Rangers.
They
got G.I. Joe, Transformers.
Yeah, I like ponies and Dungeons and Dragons. Of course, it's a whole.
Yeah, you could play can you play a pony in Dungeons and Dragons? Because you could kind of be anything you want in Dungeons and Dragons.
You can be anything you want in Dungeons and Dragons.
Do you have any other movers, or was that all you were looking at?
Should we talk about Oracle? Let's talk about Oracle. Fun. It's having a terrible day. Of course, you broke the earnings yesterday. Cloud sales growth slowed for a second straight quarter. Of course, Oracle, it's known for its database software, but it's been focusing on expanding its cloud infrastructure. That, it's still posting double-digit gains, but it's just not enough for Wall Street at this time. Not enough to compete with some of the big incumbents there. You can see stocks having a horrible day. And let's quickly talk about Sirius. This is a thorny one. Liberty Sirius XM's tracking stock group. It will combine with Sirius XM and form a new public company. The shares are up 3%. The likes of Wells Fargo coming out and saying that it's constructive, higher liquidity, lower complexity.
A new public company.
Yeah.
Interesting.
Yeah.
All right, they're going to keep at that. Okay, whatever.
We'll see.
Will we?
We'll see.
1 hour away from the closing bells. We're going to find out soon whether that comes to fruition. Stick with us. Our cross-platform coverage of today's top stories starts now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine, Bostick alongside Katie Greifeld. We're joined right now by our colleagues Tim Stenovic and Emily Greifeld. Emily in today for Carol Masser. Welcome to our audiences in full across all of our Bloomberg platforms, television, radio, originals, and our partnership on YouTube. And before we go any further, Tim, where the heck have you been?
I'm COVID-free. That's all I'm going to say.
Congratulations.
Oh, wow. You had COVID.
I had COVID, yeah.
Wow.
People still have
I didn't know this. I didn't get the memo.
Yeah, well,
oh.
that's why I didn't show up.
And I gave him a hug this morning in the dressing room. He didn't tell me.
Good thing you didn't kiss him.
Yeah.
So anyway, yeah, COVID's still going around.
Katie
you know what
going
it gave
blue.
me a lot of time
It's
to
only
do,
3
though?
in the afternoon.
It gave me a lot of time to stream.
Oh, yeah?
And yeah. I didn't stream anything on Netflix. I actually streamed the beginning of the new season of Fargo, which is actually really good, and some old seasons of Fargo.
Very dad energy of you.
However, you know, I will tell you that the big news of the day is Netflix's data being released. Guys, where were you the moment that you saw that note, that Netflix's viewership data? Because this is such a big deal.
Well, I was actually sitting right here.
I know you were. I saw you talking to Lucas Shaw about it. This is a big deal. Netflix for years has held this data so close to its chest, and for years pretty much said, we're never going to release this data. We don't have advertisers. We have no reason to ever release this data. Then, Emily, enter the writers and actors strikes.
I mean, I'm pretty surprised at these numbers of what people are actually watching. The most hours viewed, the show is The Night Agent. Personally, I've never heard of that show.
It's Romaine's favorite show.
I've been locked out of my parents' Netflix account for a while, though, so I really don't watch
that's
a lot of Netflix.
Netflix did that on purpose, probably, with their new password sharing.
Exactly. I mean, Romaine, have you seen any of these shows? Ginny and Georgia?
No.
Glory? Wednesday?
No, in fact, prior to breaking this story on air about an hour ago, I think I'd only heard of one of them, and I haven't seen it, and that was a Bridgerton story. I missed now, is a Bridgerton story, is that different than the first Bridgerton?
I think so. I think
So the first one wasn't a story. It was just, what, like a tale?
That's a good question.
You do bring up a really good point, Romaine. I did go through the 25 top viewed shows.
Yeah.
I'd actually only seen 2 of them.
Wow.
Out of the top 25.
Well, my other question to Lucas, and this was a thing too, because we should point out for our viewers, that's basically total number of hours watched. So this is going to skew in favor of, I guess, series, things that have multiple episodes, as opposed to if you just search out for just a standalone movie that's, say, 2 hours long, you know, that doesn't even rank.
Yeah, it's the methodology here is definitely not something that's like apples to apples when you compare it with any sort of like ComScore viewer data that you'd get from like classic linear TV. And I think that's kind of the point. But at the same time, it does go to show that the stuff that's, you know, international, the stuff that is big series, that stuff goes to the top. And the thing is, I actually opened the Excel document here that that Netflix released.
Oh, really?
Everything is in here. I mean, the most is like hundreds of millions of hours. The least is 100,000 hours, but there's like tens of thousands of titles in there.
So it sounds like you really spent some time with that spreadsheet too.
I did.
It's good that you did the due diligence. Let's just quickly talk about one of the other big stories of today, and that was an interesting signal about the consumer, about the holiday shopping season from Hasbro. Of course, the news there that they're cutting
I haven't heard this story.
100 jobs. Romaine and I were just chatting about it a little bit, but the timing here, we knew that Hasbro has really been struggling with that softer toy market. You think about the outlook that they gave back in October. Clearly, those struggles continuing.
Emily, do you know Hasbro's brands at all? Because Katie, when she broke the story a little bit earlier, she focused in on My Little Pony, which is pretty much on the nose for her, being a horse lover, and Dungeons and Dragons.
I knew she was going to do Dungeons and Dragons.
Which is a dragon. It's basically just like
Greifeld.
a mythical horse, right? Is that how it works?
Yeah, I don't know. I mean, I haven't played with toys in a while, and I can't imagine. I mean, there might be a lot of kids who are not playing with these toys anymore. They're iPad kids now. Can
I just say,
not Hasbro kids.
Before we go any further, I also don't play with toys.
You have to clarify, My Little Pony notwithstanding?
I don't have any, I promise.
Okay.
Yeah, I mean, and to your point, Emily, I mean, this is right. I mean, I had this conversation. I went home last night after this actually broke late last night, and I went and asked my son about it because I was thinking, I couldn't remember the last time we even bought him like a toy.
Right.
Like everything is always computer related or video game related. And I guess once they get past like being a toddler, it's like, I don't know.
Yeah, D&D's not necessarily toy related, right? It's a game.
That's like for teenage boys.
Yeah.
But that's what Hasbro's pivoting to now.
And adult boys as well.
Adult boys.
All right, we got to go. We actually got to talk about the Fed because you know they're kicking off a 2-day policy meeting today.
Sure.
Oh, do we have to
even though
cover that?
Netflix came out with that data, other stuff is actually happening. That is going to do it for now. We're going to be back with you guys. Don't worry. in less than an hour, we're going to be doing our Beyond the Bell coverage.
Is it going to be
right
both
here.
of you?
It's going to be both of us, yeah. Unless one of us gets COVID between now and then. I think we should be good. We'll be back together live on TV, radio, and YouTube on Bloomberg Quick Take at 4 p.m. for Beyond the Bell when we take you through today's market close.
And we continue our coverage right here on Bloomberg Television. Counting you down to the closing bells, those bells just about 50 minutes or so away. Cameron Dawson is here in the now, Chief Investment Officer over at NewEdge Wealth, joining us in studio. Great to see you, Cameron.
Good to see you.
And of course, you're here on I guess is a pretty consequential week. We got some economic data this morning showing an inflation picture that I guess is, well, still there. and of course, a Fed decision tomorrow afternoon that's going to be much more about the communication that we get out of Jay Powell. Let's start with the economic data first and the inflation picture and what we really learned this morning, if anything.
It means we're stuck in this unsatisfying middle ground. It's not hot enough to justify more hikes from the Fed. Powell had opened that up to saying maybe we could do more hikes in his last speech, but it's also not cool enough to necessarily justify the over 100 basis of cuts that's priced into bond markets. So we're still in this wait and see mode kind of middle ground until we get a clearer sign that inflation is in fact moving back towards that 2%.
And this gets to the idea too, but actually, I rephrase this, because Janet Yellen came out. I mean, she was asked about this in fairness, and, you know, obviously former Fed chair, but she kind of said she thinks that last mile to 2%. It's going to be difficult, but she thinks that we're going to get there and get there relatively soon. And it gets to the idea, I know Jay Powell can't really come out and say that, but I wonder if that's the communication that maybe he should try to strive for. The idea that the Fed isn't done, but don't worry, we're going to get there and everything will be okay.
Yeah, and I think kind of the burr in their craw right now is that super core inflation, the core services ex shelter, because that's been sticky around 4%. And remember, the labor data that we got last week showed wages being a little bit hotter than expected. So it really brings you back to the labor market, the fact that wages are not consistent with 2% inflation at this time. But the question is, do you actually have to see labor market pain in order to get wages back to a level that would be consistent with 2%?
Let's bring this conversation to the markets. We were discussing this a little bit earlier with Sonia Meskin, that it just feels like no matter what Jerome Powell says, no matter what some of these Fed officials say, that the equity markets have found a way to rally, really in love with the idea that we're going to get pretty substantial, meaningful rate cuts next year. Is there anything that Jerome Powell could say tomorrow at 2:30 p.m. that would upset that narrative?
Only if he repeated the Jackson Hole speech back from 2022 or I guess it was 2022, where he was ultra hawkish and Hawk's greatest hits. I think at this point the market is saying effectively we might not get the rates cuts as soon as expected, but the next move is lower, not higher, which is why I think it's shrugging off the higher inflation data today. The question is, though, do we see the Fed confirm at all that 120 basis points of cuts? And does that matter for equity markets? I think the good kind of thing to judge about 2023 is that we had a tighter Fed than expected, and it didn't matter for equities. We still saw huge multiple expansion.
Well, to that point, the fact that we had all of these rate hikes and it didn't really matter for equity markets, are those rate cuts going to matter when you think about the corporate fundamentals?
Once we get past 20 times earnings, we're trading just above 19 times today. The only times we have traded above 20 times earnings was in 2020 and 2021, when you had huge support from the Fed. And then the last time before then was, of course, during the tech bubble. So I think in order to get above 20 times earnings, which just means that for markets to see considerable more upside, you have to see support from the Fed. So if you don't get that support, you're likely near a local peak in valuation.
That gets to the whole question about, there are a lot of people that are saying, okay, they're looking for that value now. And look, I mean, I understand the broader market probably is either overvalued or maybe not necessarily cheap. But when you look at individual stocks, are you finding more value in certain areas?
Certainly. There's a lot of beaten up areas, things in healthcare, for example, where we're finding names trading in the single digits versus earnings, which is pretty incredible given the movement we've seen in other pockets of the market. So the equal weight index may be imperfect because of its weighting to different sectors, but it's a good reminder that it's trading at only 15.5 times, and its valuation is only up 8% this year. You compare that to the S&P 500, up more than 20% in its PE multiple. So the fishing ground for being able to find places for value is a lot more full in those non-cap weighted indices.
All right, Cameron, it's great to speak with you ahead of that Fed decision, the final one of the year. That is Cameron Dawson. She is Chief Investment Officer over at NewEdge Wealth. Now, coming up, Ukraine President Zelensky is in Washington asking for more help in the fight against Russia. But Republicans say that they won't act without concessions on a border deal. We'll have the latest.
And we're going to have a conversation coming up with David Hunt, the president and CEO over at PGIM, his outlook for the year ahead.
And we'll discuss the future of soccer in the U.S. with Dan Hunt, president of FC Dallas. I assume no relation to David Hunt. All that and more coming up. This is The Close on Bloomberg.
All right, here in the U.S., Major League Soccer may be in its offseason, but preparations for the 2024 season, that never ends. FC Dallas recently announced its roster for the upcoming season as the league seeks to build engagement with fans in a competitive live sports market. Pleased to say, Dan Hunt is joining us right now in studio. He's the president of FC Dallas and chairman of efforts for the 2026 Dallas World Cup. Let's actually start off with that. And Dan, I'm curious about some of the efforts, first of all, with FC Dallas and the new season. You guys are coming off, it was a pretty decent year, and there's been a lot of improvements, and the fan engagement has improved overall for MLS. And I'm wondering, what do you anticipate for the new season that is going to be an improvement over what we saw in the most recent season?
Yeah, look, we had two really big things in MLS this year, and it was Lionel Messi and Apple TV. And what both of those things did for Major League Soccer was remarkable. And you see the benefit we're experiencing in Dallas. Our season tickets right now are at the highest level they've ever been going into a new season. And also our viewership numbers were the highest they've ever been in the 2023 season. I mean, when Lionel Messi signed, Apple added 110,000 subscribers that day. And it basically made MLS a global name in the soccer markets now.
That also brings us to the World Cup that's going to be here in the U.S. Obviously, a big chunk of that will be in Dallas. And I am curious, I remember when I was a kid and they had the World Cup, I think it was Los Angeles or somewhere, and it really kind of created this sort of upswell of interest in soccer, which, of course, for the rest of the world, everyone was familiar with. I'm wondering, given how much progress we've already made here in the U.S. in getting soccer into the sort of the ethos here, how much is the World Cup going to matter in sort of building that base even further?
Yeah, look, the 1994 World Cup was in the United States. It was all over. Dallas had fabulous games. The final was in L.A. Major League Soccer was born out of the 94 World Cup. Actually, the league was supposed to have started in 1995, but started in 1996. But the United States wasn't really ready for the World Cup. Now we're a soccer-crazy nation, and it's going to be a North American bid. So games will also be in Canada and Mexico. And we're going to have the largest tournament ever. It'll be over 100 matches played with 48 teams. And I guess people always ask me what my biggest hope is. And my big hope for it is, one, I want the United States to do well. I think we're well suited for it. But there is a whole generation of players that are 0 to 16 that will be watching the World Cup, having that experience, and I hope it allows the United States to produce the next Lionel Messi.
All right, I'm going to pivot here. I'm going to go from soccer to football because I really want to talk about Taylor Swift. You, of course, are the co-owner of the Kansas City Chiefs. And Romaine, I don't know if you heard, but Taylor Swift is dating Travis Kelce. What has that meant for football? The fact that you have really the biggest pop star in the world dating, obviously, one of the Kansas City players.
Yeah, look, Travis is an all-time great guy, and you're right about Taylor Swift. I mean, she is amazing. She's a global superstar and what she's accomplished. We had her at 2 tour dates at Arrowhead Stadium in Kansas City, and just the economic impact of that was amazing. The really cool and amazing thing, though, is it's sort of activated a whole new viewership audience for us specifically, which is young women aged 9 to 17. And I guess the social side of it, which has been really fun to experience, the amount of dads that I have had say to me that, hey, my daughters are now interested and they're watching Chiefs games with their dads. I think it's really kind of a neat aspect to this. Obviously, the economic impact is unbelievable, but the social impact, I think, will be measured out over a long period of time. But these are building lifelong fans for the NFL.
Yeah, it is pretty amazing to watch. And you're talking about little girls there, but I will say a lot of millennial women, too, that I know, just anecdotally speaking, are watching more football games than they have in the past. But bringing it back to soccer, does soccer need a Taylor Swift to unlock a broader audience, or is Lionel Messi probably enough?
Look, I don't want to say Lionel Messi is Taylor Swift. I think they're two of a kind, though. They're two of the biggest global superstars, and we're so thrilled to have him here. And we're thrilled to have Apple as our partner. I mean, we couldn't have picked a better partner to show those games and broadcast the product. I mean, the FC Dallas experience is so much better now with Apple TV, and we continue to grow our own fan base, and I think every MLS team is doing that. And we're going into a new season with unprecedented momentum, and you are excited about the new players that are coming and excited about the national team players that are being developed as we head towards World Cup 2026.
Talk to us about, I guess, the competition for eyeballs. I mean, there's a lot more, I guess, major sports now. I mean, years ago, you kind of had baseball, NFL, football, and then, of course, the NBA here. But now you have soccer, you have other sort of secondary sports that have just really risen in popularity here. Does that become, I guess, is there enough space, I guess, for all of those leagues?
Look, I think viewership is different now and how people consume media. There was so much of a push into social media and getting your highlights on a Twitter or other spaces. But again, for us, Apple was the right time. And the way Eddie Q thinks about things there at Apple and the whole team and the constant innovation. You look at all the ancillary programming that they've come up with and all the new standards that they're adding. I mean, it's just an exciting time. But you're right. We are in a crowded marketplace, and it's not just sports, it's entertainment like Taylor Swift. I mean, she alone was a boost to the whole U.S. economy this year, or the global economy, I should say. So you're in constant competition, and you have to reinvent yourself every single year, or you will lose that viewership following you.
All right, Dan, really, really enjoyed this conversation. Great to see you on set, too. That is Dan Hunt. He is FC Dallas president and the chairman of Dallas's 2026 World Cup efforts. Much more coming up. This is The Close on Bloomberg. Well, Apple is beefing up security, adding a feature to iPhones to prevent thieves from gaining access to critical device data in the event that they know a user's passcode. This crossing the wire just a few minutes ago, Romaine, that Apple has released the first beta test version of iOS 17.3. This includes a new stolen device protection feature that will require Face ID or Touch ID with no option to use a passcode.
I guess this makes sense here, particularly when you consider what's on your phone now, right?
Yeah.
I mean, you think back a few years ago, it was just, a few apps and some games, and now you've got the Apple Wallet and all types of sensitive financial information.
Photos of my social security card.
Okay, you should probably delete those.
It's on the cloud.
Yeah, this is on the cloud. You trust the cloud?
Yeah, exactly.
But I mean, it kind of makes sense that they would start taking these steps here. And there's been, I mean, obviously a lot of attempts at accessing this data. You get alerts from Apple all the time saying you need to update right now because, some mysterious, cabal has someone to it, and you never do.
Yeah.
But nevertheless, I mean, other than them basically stealing your social security number and the social security
credit
number
card info
of your horse, Gus.
Yeah, exactly.
It gets to that idea, though, too, about where these mobile devices have gone and how you can make them more secure, but at the same time, make them still easy to use, right? Because there's a sort of this balance. If you make them too secure, then, I don't know. I mean, let's face it, how many times have you forgotten like a password or passcode?
I know. Well, I just do 1, 2, 3, 4 as my passcode, and then that tends to work out pretty well. I guess it's harder to fake my face.
Yeah, I guess, okay, so like a couple years now when we're doing a whole episode about how your identity was stolen and somebody took off to Monaco with all your money.
I'm committed to reporting this out.
Okay, well, real boots on the ground reporting,
exactly.
Right? A first-person account of Katie Greifeld and identity theft.
This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're about 30 minutes away from those closing bells. And of course, we're just about, well, a couple of weeks away from the end of the year. Everyone's looking ahead to what 2024 may bring and how to build and invest your portfolio for that year ahead. Pleased to say joining us right now in studio is David Hunt. He is the CEO over at PGIM. Thanks for being here, David.
Well, thanks for having me back.
This has been a year in 2023 that I think defied a lot of expectations. I'm sure you remember we came into this year expecting a recession. We came into this year expecting a lot of pain in equity markets, and we kind of got the exact opposite. And the big question everyone wants to know is, whatever led to that this year, to the upside, is that going to continue into 2024? And if so, why?
No, it's a great point, and I think all people in the prediction business were led to a lot of humility, I think, over the last year, and so I think that the most important thing for long-term investors is to focus on what's really changed in the regime. And for us, we believe that over the next few years, we will have somewhat higher inflation and somewhat higher rates than we've had kind of in the previous decade. And I think that that's really important because we had a decade before the pandemic when savers were effectively penalized around the world. And it led to this enormous hunt for yield, and it pushed a lot of assets into much riskier things, probably than they had business being. My real hope is that we are now returning to what I think is going to be a healthier balance between savers and investors. Actually, retirees and pension funds will do better. And in that higher for longer view, you are going to see a big rotation into credit. And we can already see that beginning to play out in the institutional market. We're starting to see some signs of it in the retail market. And I think that's going to be a big theme for next year.
That rotation into credit, what does it come at the expense of?
So in the initial days, a lot of people actually used their public bond portfolio for liquidity. And a lot of the money that came out of that, because there was a lot of pain, obviously, as interest rates rose fast, went into money market funds. And that's where it's been for the majority of this year. So what we're seeing now is money is coming out of money market, and we expect that to be at a much higher level next year. People are going to draw down on that excess savings, and institutions are going to draw down on the liquidity they've had, and they're going to be putting that money to work in the public fixed income markets in levels that we haven't seen in a number of years.
And of course, watching just money pile into money market funds. Well, we're at $5.9 trillion right now. It's really one of the more stunning stories of 2023. But let's talk a little bit about that rotation back into credit. You mentioned the public fixed income markets. What about the private credit markets and private markets in general?
Well, I'm really glad you raised that, because obviously private credit is a really, really important part of certainly our business. I mean, our private alternatives businesses are one of the largest in the world, and we have about $300 billion that we invest in that. And private credit has been probably our fastest growing business. And the reason for that is not only the rate environment, but it's also been that the banks have continued to really be very difficult lenders into this market. They, following the GFCs, have had a lot of capital restrictions put on, and people are expecting those restrictions to get even more punitive over the next year. And so we are seeing that many, many middle market companies are looking for private credit opportunities, and many investors would like to have that in part of their portfolio. And so I think we're kind of only halfway through the real development of a big shift of much more investment by institutional investors into private credit writ large across all sorts of strategies.
And it's really interesting to hear that that's your fastest growing business. A question I keep coming back to around conversations around private credit, the growth has been fantastic. But you think about from the investor standpoint, you can get pretty good returns in the public market right now. You think about the high yields in the public fixed income markets. You have a lot more transparency as well. What necessarily is the pitch for private credit over public credit?
Well, as I said, I think the big rotation for the next year is going to be actually into public fixed income. As one of the largest fixed income managers in the world, we really see that across our strategies. And when you can be paid well and people are now comfortable taking some duration risk, I think you're going to see that rotate very clearly in. In private credit, what you're getting is, at least in our model, you're getting a directly originated product. So we're out calling on middle market companies. We know the companies, and we're able to get covenants and other forms of protection that mean that we earn a little bit of a higher return than the public markets. And when things go south, as they inevitably will, we actually have excellent protections for our investors. So our total return over the cycle will clearly be higher.
All right, well, this could be a big structural change in how people invest going forward. I am curious about what I think is probably another big structural change going on, and that's actually in Japan, going on with its economy, with its fiscal policy, and with its monetary policy. And investors really seem to be trying to front run this right now.
You know, it's a great point, Romaine. I think that one of the bright spots around economically has been the story of Japan. I wish I could tell you that they have kind of fully implemented a lot of the governance reforms that many institutional investors have been pressing them for, but they have made good progress. The economy itself is in better shape, and they are starting to see some movement on prices, which is, you know, for many years they were not able to do. So I do think the story in Japan is more positive than we've seen, and at least for us, and we have a big business there. That's been extremely good news for our investors.
Is the sense here that the decisions that the government is going to have to make and the monetary policymakers have to make, is that going to draw more people off the sidelines, meaning more foreign investment coming in? Or the other fear that a lot of people have had is that the domestic investors there will actually pull back, retrench from places like the U.S. and elsewhere?
No, I think you will see more capital going into Japan, absolutely. I mean, one of the interesting things that's happening, and I was just there 2 weeks ago, is that you can feel this pivot globally away from China and toward, you know, Korea, Japan, Australia, and you can feel that from a security perspective, you feel that when you talk to a lot of the diplomats, and you feel it from an investor perspective.
I want to go back to the U.S. I want to talk about one of the other big stories of this year, which of course has been commercial real estate, especially coming out of the banking crisis that we saw in March. You said in June that you see 60% of the office real estate market in purgatory, that you're going to see a big workout over the next 24 months. Where are we in that timeline?
I mean, regrettably, we're still in the rather early days of that. I would still hold to my sentiment that a lot of office buildings that were built more than 10 years ago are really not fit for purpose. And if they don't have great locations, I think they're going to have a bit of a hard time. But I would also emphasize that, you know, real estate is not the same as office. There are many other spaces within real estate that are actually doing pretty well. For us, multifamily has held up better than we would have hoped and has actually been doing well. Specialty real estate, by which I mean senior housing, data center funds, infrastructure, has actually all done really well through this. So I don't want everything to be painted with the same brush as we do in office, which has a long way to work itself out.
A long way to work itself out. Well, let's talk a little bit more about real estate. Bringing it back to the banking conversation, banks obviously had a lot tied up in commercial real estate. Have we seen them draw out of the real estate market more broadly, and has that created opportunities for you?
It has. So there's no question that the pressure they've had on capital, as well as the fact that they've had to take some reserves against their holdings, has meant that there's much less money that they're willing to put out into new projects and new developments. And so private capital has really stepped into that. And we're one of the largest private real estate debt providers in the U.S. and increasingly in Europe. And I think that we are absolutely, provided we adhere to our underwriting standards and we keep leverage at a reasonable level, we like the risks that we can take in there.
All right, well, that's a good place to end it. David, it's really great to see you, especially on set. That is PGIM CEO David Hunt.
Thank you.
Now coming up, it's the top three, where we focus in on the top three movers and shakers at the center of the day's biggest stories. That's next. This is The Close on Bloomberg. Time now for the top three. Every day at this time, we do a deep dive into the people at the center of today's top stories. Joining us now is Scarlett Fu. Scarlett, who are you watching?
I am watching the one and only Sam Bankman-Fried. He is getting called out for, well, by his own lawyer as being, quote, the worst person that lawyer ever saw to a cross-examination. This lawyer, by the way, is a Stanford law professor who led SBF's defense as a favor to SBF's parents.
Now he's worried maybe that ended their friendship. We're talking about David Mills. That's the guy's name. It's pretty interesting to get this account after the trial, of course, got so much publicity.
I mean, everyone's making a lot of hay over this story. And my first question was, should his lawyer be saying this? I mean, even if he was awful, I mean, I don't know about confidentiality and all that, but
I think he's worried about his reputation going forward.
Okay, well, then he shouldn't have taken the case. I mean, don't badmouth your client after the fact. And he lost the case.
Yes, he did.
So isn't that on him?
He did say that the case was practically unwinnable given the pretrial rulings and also the fact that the prosecution witnesses made their case so well.
Okay, well.
Again, all after the fact.
I will say that a lot of people involved in the defense said a lot of things.
Yeah.
Specifically, Sam Bankman-Fried was pretty loose-lipped. So.
Okay, all right. But, you know, if you're a lawyer, keep your mouth shut and move on. I don't like that.
All right, well, let's move on.
How do you think SBF feels about this? What about his feelings?
I would love to.
Where is he?
Unavailable.
He's welcome to come on the program anytime. Let's move on to our second person here. I've actually taken a look at Ed Emerson here, who's a legend on Wall Street. He basically led the commodities trading business over at Goldman Sachs. And he was actually the highest paid executive at Goldman Sachs, more so than David Solomon, earning about $100 million over the last 3 years. You compare that to David Solomon, who I think earned about $77 or $78 million here. He's basically just checking out now. He's only 47 years old. He's made a ton of money. He built that business up and now handing the baton and moving off into the thing.
He's going out on top because last year the desk posted revenue of more than $3 billion.
Yeah. Oh, yeah. I mean,
this was George Costanza going out on top.
Yeah, and this was one of the few bright spots. You know, Goldman's had a lot of issues, and the commodities desk was actually one of the bright spots over the last couple of years. Hopefully, no one will badmouth him once he's gone.
Well, it will be interesting to see if he goes somewhere else. Like you said, he's
only 47.
He's made a ton of money.
And he's got $100 million, probably more than that in the bank. But
exactly. So we'll see whether he lands somewhere. He's interesting because he was also known as a vocal critic of David Solomon.
Well, I thought that was, that was interesting too, particularly our story and how he was friends with John Waldron and some other people. So a lot of back office drama there. We should point out he's actually staying with the company as an advisor, so he's not completely retiring.
Well, let's also talk about our third person. That, of course, is Claudine Gay. The Harvard president is keeping her job despite calls for her resignation. The school's governing body released a statement saying, quote, "In this tumultuous and difficult time, we unanimously stand in support of President Gay." Of course, that is their position. You know that alumni and very wealthy donors, this is sparking a little bit of a rift, to put it mildly.
It did take, however, one day for Harvard Corp, which is the school's governing body, to publish that statement, in contrast to MIT's unwavering support behind their president, Sally Kornbluth.
True.
So that's notable.
All right, still ahead. We're counting you down to the closing bell. Jeffrey Kleintop up ahead, Charles Schwab's Chief Global Investment Strategist. Just 14 minutes until those bells. Stick with us. This is The Close. This is the countdown to the close. Romaine Bostick here alongside Scarlett Fu, joining up here as we count you down to the closing bells and take you to the bell and beyond. We got some interesting economic data this morning, Scarlett. I'm not sure it changes anything here.
I don't think it does.
And it looks like based on the price action in the market here, they don't really seem to think so either.
Yeah, but the market's lurching from event to event. Right?
Yeah.
You had CPI, you had the 30-year auction, now you have tomorrow's Fed decision. Everyone's just kind of wait and see. Big caps are modestly higher. The small caps are trailing, which is interesting given that we're at the start of, usually when you start to see them outperform with the January effect. The 30-year, of course, in focus with the auction today, fairly well received in contrast to the last sale in November and yesterday's 10-year auction. But the big mover, Romaine, is really oil, below $69 a barrel. On signs that there's plenty of supply, even after all those production cuts by OPEC+.
Yeah, I've been really fascinated by the moves in oil, and we don't have it on the screen, too, but I want folks, if you have a Bloomberg terminal, take a look at gasoline futures as well. The first settlement that we've had below that $2 a barrel, $2 a gallon mark, is basically going back to late 2021 here. So obviously that's a net positive if you're a consumer, but it doesn't really say a whole lot about what's going on in the industrial side of the economy. Let's get some insights into what's going on today, and more importantly, what could potentially go on over the next year. Jeffrey Kleintop joining us right now. He's Charles Schwab's Chief Global Investment Strategist. Pleased to say he joins us here in a very chilly New York City. Great to have you.
Hey, thanks for having me.
All right, let's get right to it here. I mean, everybody's already making their predictions for 2024. I am curious about sort of the bigger, more structural issues that might come up, both either negative or positive, that might come up over the next year that you're paying most attention to?
Well, it's going to be a chaotic year, I think, in terms of the data, because we've got different parts of the global economy moving in different directions. It reminds me of a scene in my favorite movie, Ferris Bueller's Day Off, where Cameron is at the museum focusing on that painting closer and closer and closer till it just dissolves into a few pointillist, chaotic dots.
Yeah.
That's 2024. We've got the manufacturing sector maybe making a recovery next year, but the Taylor Swift economy, the service economy, maybe heading down. Germany's economy picking up. France is turning over. The Bank of Japan raising rates while the Fed cuts. A lot of chaotic data points, but I think through it all, if you step back, is a recovering global economy, recovering earnings, and declining interest rates. I think that's still a bullish equation for stocks.
But that gets to this whole idea of Goldilocks, soft landing, pick your euphemism here, and if you even want to stick with the Ferris Bueller reference here, are we going to be sort of looking at a scene, where, the garage attendant, steals a Ferrari and takes it on a joyride, or are we looking at towards the end of the movie where Cameron sort of pushes the Ferrari out of the house and down the cliff? I know we're going way down the rabbit hole here.
I think the key is that it's going to be a year where it's difficult to foresee. Each of those data points could be going in different directions. I don't think Taylor Swift can save 2024. I do think the service, we didn't just see it in the U.S. Japan saw the biggest tourist revenue they've ever seen in any year. Travel and entertainment was huge. We don't have that wind to our back in 2024, but we do, I think, have a firming manufacturing picture. And I say that because we're 15 months into the PMI being below 50 for global manufacturing, longest stretch in history. That should begin to work out as inventories come down. So I think we begin to see a pickup there, offsetting some of those other declines. And that could mean a more positive earnings picture. We've got more companies focused on manufacturing than services, actually, in many of the major indices. So that could be a boost.
That's a good point.
So the one thing that always bewilders me is that traders continue to bet on a Fed pivot, and they continue to bet on this, and they've been wrong so many times. I think it's been 6 times so far. Yes, people see rates no longer rising, perhaps starting to moderate next year. But why is the market so insistent on pricing in a bond rally off the back of a rate cut early next year?
Yeah, it seems like a one-trick idea that everyone seems focused on. And I think maybe because the leadership, at least in U.S. markets, has been so liquidity-centered, right? It's all around those Magnificent Seven. And if we do get aggressive rate cuts next year, they can continue to fuel the rally. I think you have to look elsewhere for that performance. One thing that's interesting this year is the average international stock outperformed the average U.S. stock. Equal-weighted index, S&P 500 versus the EFI index. EFI won. People don't know that because that Magnificent Seven. I don't think we're going to see the flood of liquidity that many traders and investors are betting on, and that's why I bet on those broader markets overseas.
When you say broader markets overseas, how do you want to get that exposure? Through passive investments like index funds, or are you going in there picking individual names because you want to be looking for specific characteristics?
I don't think you have to be as specific when I'm looking at next year. When an asset class is out of favor, you want to be very targeted, maybe very active. I think you can be very broad in that exposure. I talked about Germany's economy recovering. Japan is on track. I think the Nikkei could hit a new all-time high next year, eclipsing that December '89 high. So broad global diversification through passive or active investing, I think, could work next year.
Does that include Europe, though?
It does. Yeah. Europe is, I think it's got a consumer that can come back. The wars, the recession has really weighed on them. I think there's a momentum there for them to spend a bit more. And you've got a lot of the businesses really keyed into what's going on in China. So a little bit of Europe is dependent upon a Chinese consumer recovery, which I'm hoping unfolds with some of the support they're giving to the housing market.
For those folks here in the U.S., I am curious as to how much the correlations matter, or if the correlations of history with regards to how the U.S. economy does relative to the other major economies around the globe. Does that matter as much anymore?
It still matters in that the U.S. consumer is still very important. But, when I look at the markets in 2024, I'm more focused. It used to be that if the U.S. sneezed, the rest of the world caught a cold. I think from a markets perspective, if Japan sneezes, the rest of the world's markets catch a cold. Japan is a net investor to the rest of the world. It's $3.3 trillion. If the Bank of Japan really hikes rates next year, that's the biggest risk for non-Japanese assets, a repatriation of that money back to Japan. I'd watch out for that.
All right, Jeff, we're going to have to leave it there. Always great to talk to you, and great to have you here in person. Jeffrey Kleintop over at Charles Schwab, giving us his outlook here as we count you down to the close here on this Tuesday afternoon. Some breaking news crossing the Bloomberg terminal right now involving Elon Musk and the X platform, the social media platform formerly known as Twitter. We're now learning that 2023 ad sales are projected to slump to about 2.5 $2.5 billion. That is the main headline crossing the Bloomberg terminal here. So for the full year 2023, ad sales on the platform X expected to be about $2.5 billion, according to people familiar with the situation. I'm not quite sure what the comparison is.
I'm looking at the story right now, written by Kurt Wagner, and it compares to more than $1 billion per quarter in 2022. And we know 2022 was already a bit of a drop-off from previous years as well. So it's not clear what Elon Musk's strategy is when it comes to Twitter, now X, because he's been pretty vocal in just being out front and pushing back against all these advertisers who say that they're going to put a pause on their support of the platform.
Yeah, I mean, that's one strategy, I guess,
Is it a strategy, though?
Twitter Spaces with Andrew Tate and Alex Jones is another approach to it as well. A non-publicly traded company with the world's richest man now projecting ad sales of about $2.5 billion for the full year. Going back to the public markets and the stocks that you can actually invest in here, fractional gains once again on the day for the S&P, the Dow, and the NASDAQ. Meanwhile, the Russell and the mid-caps lower on the day.
All right, and of course, we're moving closer to the closing bell, aren't we? We've got a couple of earnings coming out. The one that we want to pay attention to the extent that you are looking at it, is Adobe.
Yeah, absolutely. Stick with us. Full coverage up ahead here as we move closer to those closing bells and take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine, Bostick alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with Tim Stenovic and Emily Greifeld. Welcome to our audiences across our Bloomberg television, radio, and originals platforms, as well as our partnership with those folks streaming on YouTube. Tim?
Do stocks go down anymore? It just seems like they go up. At least that's what we've seen over the last 6 weeks, Emily. Get this, the S&P 500 right now is at the highest level since January of 2022. Same with the NASDAQ 100. You have to go back to January 3rd of 2022 to actually see levels this high. We are pretty close to all-time highs on the S&P 500 and the NASDAQ 100, Emily.
But Tim, we are seeing some stocks go down. I'm looking at Macy's. It saw the worst intraday decline since August after Citi has expressed some skepticism that that $5.8 billion buyout from Brigade and Arkhouse Management will actually materialize. I'm also looking at shares of Oracle, plunging the most in 3 months after reporting cloud sales growth that slowed for a second straight quarter. Scarlett,
and you wonder whatever happened to the broadening of the rally that everyone had anticipated. And it looked like it was happening for a while. I look at the Russell 2000 right now, off by 0.1%. I bring this up because we're getting close to that period where you should start to see the January effect come into the market, where people start bidding up the smaller cap stocks for a period of a couple of weeks before they switch back to those big caps.
All right. Well, we started to see some broadening out. I guess the question is how much does that carry over into next year? We should point out, too, I mean, you have the S&P and really all the major indices here in the U.S. sitting on pretty healthy gains. But as you pointed out, we were talking with our earlier guests here, you're still seeing record levels in France, record levels in Germany. The MSCI All World Index is less than 5% away from a fresh high. And then, of course, whatever the heck is going on in Japan sitting there, and their benchmark index up about 26% here on the year. The Dow Jones Industrial Average here in the U.S. finishing the day higher on the day by about 173 points, or 0.5%. Similar moves for the S&P 500 on a percent basis, a 0.5% gain. The pins at right around that 46-43 level. The NASDAQ Composite higher by 100 points, or about 0.7%. And the Russell 2000, which Scarlett was just referencing, down on the day. That's your laggard, down about 0.1%.
Yeah, not a bad rally if you take a look at the S&P 500 and peel back the layers. 3 stocks higher for every 2 stocks that were lower. We have 299 stocks in the S&P 500 moving higher, Scarlett, today, 201 moving lower. Similar sort of breakdown on the Dow, 21 stocks moving higher, 9 moving lower.
All right, let's take a look at the sector performances because it is overwhelmingly in the green. We have chip companies leading the way, up 1.5%. Broadcom is a notable advancer there. Commercial and professional services and insurers also rising quite a bit. On the downside, all 23 members of the S&P 500 Energy Index are lower on the back of falling oil prices, with WTI below $69 a barrel. Autos and components, as well as telecom stocks, are down.
All right, well, let's take a look at some of the notable gainers on the day today. I want to start with the best performer on a percentage basis in the S&P 500. Insight closing higher by more than 8.45%. This biotech firm up for a second day in a row. Yesterday, it rose 4.3%. All that because of what the company said happened in a trial of its treatment for patients with refractory chronic graft versus host disease, also known as GVHD. They'd received at least 2 prior lines of systemic therapy, and in that trial, they met its primary endpoint. Investors certainly happy about that, making it the best performer on a percentage basis in the S&P 500. Scarlett, you mentioned Broadcom, ticker AVGO, among the best performers on a points basis in the S&P, up for a second day in a row as well, actually hitting a record high today, up more than 4.1%. The company rose yesterday by more than 9%. This after Citi restarted coverage with a buy recommendation, writing that AI tailwinds will help to offset a correction in the company's semiconductor business. And we saw continued strength over the last couple of days in the chip sector. And here's a fun one for those who may be eating lunch on the West Coast right now. Kava Group, the company that owns and operates the Mediterranean fast casual restaurants, shares spiking today by 19.6%. A lockup agreement that prevented company insiders and other big shareholders from selling shares actually expired today. Oftentimes you see stock move lower when that happens.
Yeah, I was sort of confused by that. I mean, if it had gone up, fine, but to go up 19-20% was just kind of odd.
It's still down more than 30% from its July highs, Romaine, but it still was a surprising move to see, because oftentimes you see, insiders sell stock, but if they're holding on to it, I guess that'll make
it looks like some did. I think the other issue, though, too, is when you looked at how small that float was, maybe they added putting those shares back out onto the market maybe provided somewhat of a boost.
That's a very good point.
Yeah.
And looking at the decliners, as I mentioned, Macy's having the worst intraday decline since August on that Citi skepticism here about the $5.8 billion buyout deal. This is really a change from yesterday, because we saw that stock up over 20%, with some analysts even saying that the buyout was too low. That, of course, the offer coming from Arkhouse and Brigade. Now Citi saying, given the macro environment, the interest rate environment, it might not be the right time for a deal to really materialize here. I'm also watching retail sales, so I'm very focused on this retail sector this week, particularly when you look at the Macy's move and the decline for today. I'm looking at Oracle as well, because they plunged the most in 3 months after reporting that cloud sales growth had slowed for a second straight quarter. We're seeing that stock down as much as 12.5%, the biggest drop since September. And Johnson Controls is also on my radar. This is a maker of fire, heating, and cooling equipment. They're a $35 billion company, down as much as almost 6% today. They had a cyber hack recently, and there are a number of analysts coming out and saying that their earnings that recently missed are really coming down to that hack, and the restraints are really going to continue into the next quarter and the next earnings season.
All right, Emily, let's take a look at what's happening in the yield space. Overall, a flattening out of the curve, but you go back to 8:30 a.m. this morning when we got that CPI report out of Washington here, and the knee-jerk reaction was pretty swiftly to the downside, but most of those bets really sort of flipped here, and you start to see a lot of selling come back into the short end of that curve, and that pushed yields ever so slightly higher on the 2-year, only by about 2 basis points here at the close. Meanwhile, the rest of the curve you did see down here on the day, roughly by about 2 to 3 basis points, depending on what part you're on here. And I do wonder, Scarlett, if that is a direct reaction to the CPI report, or maybe people are still waiting for tomorrow to hear what Jay Powell has to say.
Also, the 30-year bond auction, which was fairly well received, all things considered. It was certainly better than the last time they sold the 30-year bonds. And the Monday auction, as we were talking about earlier, was not that well received. So good news, I suppose, for people who are looking to add duration.
The question I have with, that the Fed is considering potentially right now, Emily, is when it comes to the bets that people are placing right now on the actual cutting of rates next year. And we saw the bets kind of decline ever so significantly. What are we down to? About 108 basis points of cuts for next year after that CPI data came out this morning. So it fell ever so slightly, but it seems like everybody, the general consensus is the Fed is going to significantly cut rates next year. And I'm still thinking to myself, wait a second, there's a history of the Fed cutting rates too early and inflation actually coming back.
That's why I really don't expect Powell to be that dovish in his presser tomorrow, because the market has pretty much done a lot of this work for him. He's likely to be more measured because he doesn't want traders to get too excited. We've already seen such a loosening in financial conditions, especially when you look at these moves in the bond market.
It almost seems like it would be ideal if he just didn't even hold a press conference tomorrow.
Don't say anything.
I just
we
feel,
could just all go home.
I mean, what can he say at this point? I mean, honestly, I think, in all seriousness, it gets to this idea, though, too. Like, everyone's betting on rate cuts. And even Powell has kind of hinted at this idea that at some point you're going to have to start normalizing the Fed funds rate to sort of match where we are in terms of market conditions as well as inflationary conditions. So that does mean, in theory, you're going to get a rate cut. Just not going to get 4 or 5 of them. But, what's the advantage of him actually saying that?
Well, he's got to talk about something because they're coming out with new economic projections. So that's fodder for someone to say something.
I have a question. When they came up with that dot plot, do you?
Yeah, I love the dot plot.
Oh,
yeah.
Okay. All right.
Yeah,
I'm
it
sorry.
helps understand.
Ignore Tim for 1 second. I'm going to talk to Scarlett for a second. So, but in all seriousness, I mean, the dots. I mean, every time they do this, and remember the last time they released it, there was so much dispersion in those dots because there's no consensus. At least when you go past, a couple of months here. I mean, it doesn't seem like anyone on the Fed knows.
Of a moment in time. It's what people are thinking at the moment based on what they've seen up until that point. And Powell himself had said that once you get farther out from those dots, the forecast, maybe the first month it's relevant, and after that it no longer is relevant.
Right.
So
We have no idea
we
have no idea what's going to happen in the economy. I think the difference between now and when we last got the dot plot is so much data coming in that shows that we actually are seeing a softening of the economy and a so-called, kind of the perfect conditions for a soft landing. So do you think we'll still continue to see a big dispersion like we saw last time, or we see more consensus, guys, that the Federal Reserve officials actually agree as to when the Fed will start moving rates lower?
Or people be really cautious and not want to signal too much by changing up their forecasts.
All right, we'll find out tomorrow. That's
why was it dots instead of dashes?
I don't have the answer to that. I'll look into it. I'll get back to you about it, okay?
You do that.
And also,
please.
if you're watching or listening and you know the answer to that, let us know. That goes for folks on the Fed as well, if you're not too busy. Hey, that does it for Beyond the Bell. Right now, it's our cross-platform coverage of the market close on Bloomberg TV, on Bloomberg Radio, Bloomberg Originals, and YouTube. Meantime, catch us same time, same place tomorrow.
And we continue our coverage of the close right here on Bloomberg Television. Stick around. A Bronx legend, a rap legend coming up here on the program. Fat Joe, the Grammy-nominated artist behind hits like What's Love and All the Way Up, is venturing into the hair care space. That conversation coming up next on the close. This is Bloomberg. Another mixed day in U.S. equity markets here. The tone set this morning, 8:30 a.m. Washington time, when that inflation report did come out. Of course, that is the big backdrop for a big Fed meeting. A Fed meeting now taking place and a big decision and a press conference that will come tomorrow in the afternoon. You take a look at an S&P 500 adding to its gains on the year, fractionally to be sure, but big help today from the Magnificent Seven. Meanwhile, you flip it up, a 2-year yield moving ever so slightly, but only by about 2 basis points. The individual stories were much more compelling with the big downdraft in Macy's, a big rally in Kava, and now another look here at some of the solar companies which continue to be on the back foot, largely because of pressures coming from the administrations here in the U.S. as well as in China. Flip it up again here because we go back to the macro and we go back to that Fed report and we go back, more importantly, to what Jay Powell can actually tell this market that is going to change anything. At the end of the day, this is what they're going to be talking about at the Eccles building today and tomorrow here. And that is the trend line in inflation and, more importantly, whether that trend line remains to the downside. All right, we want to pivot from that and talk a little bit more about some of the folks out there who are really making moves in the entrepreneurial space. We want to talk about men who are increasingly taking their skin and hair care routines to the next level. And musician Fat Joe is throwing his hat into the ring. Rewind at 10. It's an ammonia-free, at-home beard and hair coloring line that seeks to give its customers a more youthful glow. The brand is now available for purchase online and will sell exclusively in Sally Beauty stores starting next month. Here in studio with us right now is Fat Joe, a Bronx legend, a rap legend, a Grammy nominee, and now a businessman. Well, you've always been a businessman, but you have a new business venture here. Why hair care?
Well, I've been a product of the product for a long time, so I've been using it, other products. And it just wasn't right. It just didn't feel right, didn't last long enough. And they kept making the product cheaper and cheaper, so you run out in every 2 days. And so I wanted to create a product that would give you that glow for much longer. I call it the Rolls Royce of hair coloring. And women been taking care of their appearance and they look beautiful. And every day my wife got lash day or this day or that day. And why don't you want your man looking good too?
Yeah.
And so I said, let's come up with a line. A lot of black and brown brothers can't use these other products because they literally break out and go to the hospital.
Yeah.
And so we made a product that's ammonia free. And then we threw some of our friends on there. So I said, I'm so much of a networker.
Yeah.
I think my best attribute is bringing people together.
Yeah.
Like I know all kind of people.
Yeah.
And so for
like
every
who?
color, we got DJ Khaled on the box. We got Travis Kelce on the box.
Travis Kelce, that's a good get this year.
Tyson Beckford.
Yeah. Tyson
No,
Beckford.
it's the best. It was done ahead of time.
You did it before
But now
the
I am
Taylor
an
Swift.
official Swiftie. Like, I love the Swifties. I mean, you can't make it up, and it's timing. Timing is always everything.
No. I'm sorry to interrupt, but you say timing is everything. Was there an aha moment which prompted you to take it further? You had these observations, you noticed this, but what prompted you to really dig in and say, I'm going to start this business?
Well, there was such a stigma behind men's hair coloring. Even when I would get it, I would sneak into Walgreens at 3 at night and load up on my boxes because people are almost like embarrassed to use it. And so I just wanted to give pride to men for using the product and looking better. I'm like, why you want to look 53 when you can look 40? Or why would you want to look 42 when you can look 30? I mean, why fight the time when you can rewind the time? That's it. Why fight the time when you can rewind the
Let's
time?
rewind at 10.
That's right.
Yeah. How are you making decisions, though, about what you sort of want to pursue, whether it's coming up with your own products or giving your endorsement to something else here? I mean, what's the thought process?
I like doing stuff I know about. I'm an entrepreneur at heart. When I came in the rap game, I signed guys like DJ Khaled, Big Pun, Remy Ma, Cool and Dre, Scott Storch. I helped Pitbull get his first deal. The list goes on and on. So I've always been an entrepreneur. And so in this space, I wanted to create a product that makes men feel good about themselves. And so forth and so forth. I have sneaker stores in the community, sneaker and clothing stores, and I actually have a classroom in one of the stores where we teach kids, sanctioned by the Board of Education, after school programs. And we feed them and we teach them computer skills and mentorship skills. Everything with me is about a give back. Everything is about the community.
You talk about wanting people to feel better about themselves. What do you see your brand expanding to next in terms of products?
Oh, no, this is out of here. We don't play to lose. This is a winner. You bet your money on this. This is gone. I mean, we put it on for sale the other day. I don't even want to tell you the numbers. And what's so crazy is that even when we created the brand, I was like hesitant to use it at first. I didn't know. I mean, for people who never used it, they're buy 6, get 1 free. Like, they're not taking the chance. They're going all in.
Yeah, I am curious though. I mean, we're showing you in this brand now, and I think about when you sort of came up as a rapper in the, what was that, like mid-90s or whenever?
93.
The first, was it 93 or was that long ago?
30 years.
So, but you remember back then, I mean, to even endorse something back then, you would be called a sellout. It was like, and now that's completely flipped the script. You can't even be a musical artist these days, certainly not a rapper, without having these other businesses.
It's over. And my thing is, I like to be first at everything. And so, everybody's did a liquor, everybody did a clothing line, everybody did this. So I wanted to step out and do something on my own and further ventures to go. And shout out to my sister Carolyn Aronson. She owns It's a 10, which is a big deal for the women. And so it's so important for us to get with somebody who has that experience. And she's like, I mean, anything she touches is a 10. And so we collaborated together, and Jeff Aronson, and we formed this dream team.
I noticed also that you have been very vocal in terms of lobbying for and pushing for a more equitable healthcare system.
Yes.
How do you see rewinding?
We passed a law yesterday.
Yeah, tell me a little bit more about that.
So yesterday, Congress passed a law, the lower cost more health transparency law. And, you know, when I went to Washington with Power to the Patients 3 years ago and talked about this, we had one politician meet with us. And so as we've been going now, we had 80 politicians, and it actually is a bipartisan thing. So you got over 100 million Americans that are in debt because of health care prices. So all we try to do is say, don't give us no estimates. Tell me what the price is. I can tell you what Rewinded 10 is. Tell me the price. Why? Because now you can Uberize the system. You can look up your 3 favorite hospitals, and you say, I'm going to get a CAT scan, I'm going to get an MRI.
Transparency.
This one is charging $1,800. This one's charging $800. This one's charging $400. Obviously, if it's a reputable hospital, we go for the $400. This isn't black. This isn't white. This isn't Latino. This isn't Asian. This isn't Native American. This isn't Amish. This is everybody. Is getting affected in America by these healthcare prices.
Yeah. What brought you to that? Was that because of your own personal experience?
Well, I have a good friend I know for 20 years. Yeah. And when he broke it down, and I met a brilliant woman by the name of Cynthia Fisher, and when she started explaining to me how everybody in America is being affected by this, it's just something that touched me. You know, Jay-Z got health justice reform.
Yeah.
Everybody got something. You know, Kim Kardashian got... You know, bringing people out that exonerated, right?
Yeah.
And so for me, that's the thing that touched me was the healthcare and helping the people.
All right. Well, Fat Joe, this was a great experience and very illuminating. Great to.
You know, you can rewind the time down here.
Well, when I told my wife I was interviewing, because we've been having a conversation about whether I should color my grave.
No, she wants you with the white. Trust me. They want you out the box, brother. They want you out. You better go get that rewind the tape.
I'm going to play this for her later tonight. Fat Joe, a Grammy-nominated, Grammy-winning artist, and the co-founder of a new hair coloring line called Rewinded 10. All right, we want to pivot from that, and we do want to go down to Washington. We are expecting to hear from President Biden and the Ukrainian president due to speak any moment in Washington. Let's go down right now to Anne-Marie Horton in Washington.
Hey, Romaine, that's right. We're waiting for President Biden to appear with President Volodymyr Zelensky. They've been meeting this afternoon. Of course, really, we already know where the White House stands on this issue. They've been asking Congress for billions of dollars of aid. We heard from Shalonda Young, director of the OMB, coming out with a letter telling Congress that there's no magic pot of money at the end of the year, that they are really up against this mark when they're trying to get the funds for the weaponry they want to send to Ukraine. So the more important meeting Zelensky had, and potentially we'll hear from him about how those meetings went, was earlier in the day when he met with senators and he went with Speaker Mike Johnson. Remember, when he was just here in September, it was former Speaker Kevin McCarthy. So now he has to go through everything again with a new speaker. And this is where you have some concerns. It's in Congress about Ukraine aid. And what is very clear is that while Zelensky, everyone said, has made a very prolific pitch, and it was powerful, according to Senator Chuck Schumer, there's not going to be a deal on Ukraine aid for Republicans, at least. This is what they say, until they can get a deal on domestic issues at home, and that's with the U.S. southern border. So we'll, of course, wait to see what President Biden and Zelensky say. There is one thing the president can do. They do have some more money left in the presidential drawdown. What this would mean, though, is U.S. sending U.S. weaponry before they have the money to backfill for what they'd be sending to Ukraine. And potentially that could be some wiggle room to get the United States' support to help Ukraine through the early next year. But, of course, this is very challenging. The politics of it is very challenging.
Yeah, thank you for laying out that possibility there. I guess bigger picture, Anne-Marie, has U.S. funding for the Ukraine war kind of taken a back seat to supporting Israel in its war against Hamas? I know that President Biden had wanted to package those two together, but that didn't get very far. And the appetite, it seems, for foreign aid among especially Republicans seems to be pretty low right now.
Well, the president wanted to package all these together. That's correct. And part of the thinking is if you cast a wide enough net, there's something for every congressman or woman or senator to vote for. But Republicans really want to tie, even the most defensive hawks like Lindsey Graham now want to tie a deal for immigration with Ukraine aid. And also, this is a way that potentially you're going to get more congressional Republicans to vote for it. But likely, we could still potentially see a number of items tied together, not just Ukraine and the U.S. southern border, but also Israel, which for the most part has a lot of bipartisan support. There, for Israel, the issue is actually some Democrats want to put strings attached to that Israeli aid. And then also, of course, the president talked about national security concerns in the Indo-Pacific when you think of Taiwan.
It's interesting you kind of tie those together, Anne-Marie, because there's a broader question here just about U.S. foreign policy overall and sort of what it would mean. And I know you obviously covered the Trump administration that clearly tried to look a little bit more inward and not get as involved in these things. And now you have a president who maybe sees a broader role for the U.S. overseas here. What sense of continuity do we have, if at all, that if we do have a new president in a year's time or so, that whatever is brokered today will actually be honored tomorrow?
Well, that's an issue a lot of foreign governments have with the United States. It's one of the biggest issues a country like Iran and European partners who dealt with putting together a deal like the JCPOA. It was done under the Obama administration, and then it was retracted during the Trump administration. So that's why there's consternation around the world. They're not sure what U.S. will show up. I didn't cover the Trump administration directly in Washington, but I was abroad covering throughout Europe, Russia, and the Middle East when Trump was when he was president. And one thing that sticks out for me when he was at NATO and potentially wanted to walk away and was threatening for the United States to walk away from that alliance, vastly different than the approach President Biden took, which we actually saw an expansion of the NATO alliance under President Biden. So it's a great question, and this is what a lot of individuals I still speak to abroad want to know. What is going to be the outcome of next November? Because they want to know what kind of America they're going to get. The former president is saying that he can get a deal done with Putin on Ukraine. No one really thinks that's potentially possible, but maybe there's consternation in Ukraine about whether or not the U.S. would be willing to send more funds. The issue Republicans have now about Ukraine is that polls are showing that Americans are more concerned at home with their savings, the inflation, and they want it really explained to them why they should be sending more aid to Ukraine. Mitch McConnell, Senate Minority Leader, has really spoken a lot about this to try to pitch it to Americans as this is actually rebuilding the U.S. industrial base, and it's sending jobs to places like Alabama to remake weaponry and rebuild that base. So it is also part of a domestic policy. That's one pitch many are trying to get at with their constituents.
Has that gained any traction? I mean, have other Republicans signed on to that idea?
Yeah, some have been using that. Because what would do with a lot of this money is it would be going to the U.S. defense industry, because the United States is sending by and large, the U.S. is sending weapons to Ukraine. I know we talk about aid kind of broadly, but the bulk of that is weaponry and that is ammunition. And when I speak to the Ukrainians, this is one of their biggest concerns. After they were asking for the next high-level technology or the next, it was HIMARS at one point, the next thing they'd always say is we need to make sure that we're constantly asking for ammunition and weaponry to refill the tools that we have. And they were foreseeing potentially this moment here. And I cannot really explain the contrast enough of what we are seeing, the reception Volodymyr Zelensky is getting this December 2023 than he got December in 2022. He was really welcomed in Congress, of course at the White House, which he still is, but a war hero's welcome. It was triumphant. It was jubilant. Yeah. Remember, everyone was even so shocked he was even able to get to the United States safely. And this time he comes to the U.S. feeling a bit more desperate and really trying to make his case behind closed doors with key senators and key congressmen and women.
All right, Anne-Marie Horton, down in Washington, we are awaiting a press conference with the President of the United States, Joe Biden, and the Ukrainian President, Volodymyr Zelensky, scheduled to take place any minute now. We're going to bring you that conference as soon as it happens, and we're going to also get some insights on Zelensky's trip here to the U.S. and to Washington specifically, and his return home, at least for now, empty-handed. Tina Fordham, founder and geopolitical strategist over at Fordham Global Foresight, going to be joining us in just a bit. This is The Close on Bloomberg. It was another choppy day in U.S. markets here on this Tuesday afternoon, but the net effect of it all, at least in the equity space, was stocks continued to creep higher, at least the broader market, with the S&P, the Dow, and the NASDAQ all finishing the day in the green. The Russell 2000 was a bit of a laggard, finishing the day in the red here, but nevertheless, most traders seem to have found some comfort in that CPI report earlier this morning, despite the fact that it did surprise just a tad to the upside. But whether that surprise is going to be enough to really change the dynamics and the metrics for the Fed, particularly when it comes to the big release and press conference tomorrow, most people don't really seem to think so. That was really reflected in what we saw in the Treasury space today, where the big knee-jerk reaction after that report was a swift move in yields to the downside, then a big swift move in yields to the upside, and then they just kind of settled back down to kind of where they were just about 24 hours ago. There was a big move today, though, in the crude oil space, and that is something to keep an eye on. The dichotomy going on right now between financial market conditions and economic conditions on the ground, particularly in the industrial space, something, of course, that all those members of the FOMC will have to debate, will have to weigh, and then make a decision about what to communicate to the market as to where monetary policy goes next year.
All right, let's take a look at what's going on in Washington, because President Biden and Ukraine President Zelensky are due to speak any moment in Washington. Of course, the Ukrainian president came to Congress today to appeal for more aid to resist Russia's invasion. For more, I want to bring in now Tina Fordham. She is the founder and geopolitical strategist at Fordham Global Foresight. Tina, it is always good to speak with you. We know that Zelensky met privately with members of Congress, including the Senate Armed Services Committee's top-ranking Republican, Roger Wicker of Mississippi, who said that congressional approval for aid would likely slip to early January. He said the House is not on fire when it comes to Ukraine's need for ammunition and other weaponry. Is he right there?
I thought that was an astonishing remark under the circumstances. The houses are quite literally on fire in Ukraine. Russia is stepping up its attacks on Ukraine's civilian infrastructure. We saw this playbook last year as well. The effort will be to make Ukrainian civilians as miserable as possible during the impending cold winter. And, you know, whilst from a pure political perspective, this may be an excellent moment for House Republicans, congressional Republicans, to press for advantage on immigration reform. It's very much part of what I've written about as new doom loops between politics and conflict.
Yeah, new doom loops is a really good way of putting it. I like what you said earlier about how winter is approaching. History has shown, as you know, Tina, that it's very difficult, if not impossible, to prevail over Russian or Soviet forces in the wintertime. Give us a sense of where things stand on the battlefield as we head into the coldest part of the year, and how that sets us up, how that sets up Ukrainian forces in the spring.
Well, I think that Ukraine is disappointed that it hasn't been able to gain greater ground during the offensive of the last few months, but they have put up a valiant fight. But I'm glad you asked about the situation on the ground from a security perspective, because it is really discouraging to view this conflict in Ukraine as through the domestic political lens of potential for reforms. Russia and Ukraine both know how to fight in winter, right? You know, this was something that was proven in World War II, but I just saw a tweet from Mike McFaul, the former U.S. ambassador to Russia, saying, imagine if in 1941 the U.S. had decided to delay aid to the U.K. for a year because of domestic issues. Of course, there is an interplay between domestic politics always and conflict.
Yeah.
But the urgency is real, I think, and war fatigue is another factor at play.
I understand some of the fatigue here, but there are some broader issues here that I think everyone knows, or at least recognizes, not necessarily wants to address, and that's the idea that if you don't provide the aid and Putin is successful in continuing to grab land out of Ukraine, then what stops him from just going deeper into Europe, going into the Baltic states, going into Europe? What's to stop China from doing what most people think is its long-held ambitions to retake Taiwan? What's to stop some of the big moves that are now starting to bubble up in Latin America here? There's a broader issue here. Does that not matter?
Well, it should matter, because when we, first of all, 85% of all conflicts are over territory. So people who sort of tried to dismiss these small land grabs, initial small land grabs, and I warned about this when Russians invaded Georgia and took Crimea as well. I mean, of course, you start small and then you go bigger, but if we don't respect territorial integrity, things get more complex. You mentioned Venezuela and this kind of referendum that has been put forward. Just about every country on the planet has a bit of another country it would like to take back or has some historic claim to. So, really there is the most basic principle of rule of law and order.
Absolutely here, but there are some people, as you know, and these aren't just the quacks. There are people, legitimate people here in the U.S., politicians and other sort of thought leaders, who say that the U.S. for so many years has been kind of the global police on the beat, if you will, stepping in to sort of resolve these conflicts, and has done so in many ways to some damage to itself, whether it's financially or whether it's maybe just the optics of our role here. And maybe it was time for us to step back and say, these are fights that maybe someone else needs to fight.
The Europeans have played a huge role in Ukraine, the Europeans and the UK, where I'm based. I think the US-led global order has brought the US exponentially more benefits than what it may have provided in terms of aid. The end of the Pax Americana, as it is known, is something that should worry investors, business leaders, companies, as well as global citizens. Wars take a long time to fight. Which wars is another question. I mean, Iraq and Afghanistan were very, very damaging, I think, to the U.S. sense of its global role. We saw President Obama very much chastened by those experiences. I do think that Ukraine is in another category, and frankly, what the U.S. is providing in terms of aid is an inexpensive way of dealing with one of our longest-standing global adversaries. This is a security-first world right now. If we don't protect the global order, what happens underneath it is going to be small potatoes by comparison. But yes, I mean, being hostage to domestic considerations is not unusual. 65% of Republicans think the U.S. is giving too much aid to Ukraine. This is where leadership comes in, though.
Yeah, absolutely. Tina, always great to talk to you. Very level-headed. Tina Fordham, founder and geopolitical strategist over at Fordham Global Foresight. As we do await that press conference between Volodymyr Zelensky of Ukraine and President Joe Biden here in the United States, we'll bring you that as soon as that takes place. But we do want to turn our attention to another building in Washington where we are expected to get a Fed decision at 2 p.m. tomorrow out of Washington. And, of course, a big press conference by Jay Powell with a lot of decisions he has to make about what he wants to communicate to the market and to the people writ large. Nathan Sheets, global chief economist over at Citi, joining us right now to discuss. And I do want to start with the communication because we know we're not getting any real change in policy here. But I think he does kind of have to set the tone for what 2024 could bring, particularly in light, Nathan, of what I'm sure you've seen, which is a market that pretty much seems determined to see 4, maybe even 5 rate cuts in the next 12 months.
I think you're absolutely right. This meeting really is about communication. And in previous meetings, Jay Powell has sought to engineer a hawkish hold. And he has done that by arguing, yeah, I'm not moving today, but we're prepared to hike if necessary. And indeed, there's been a hike for December, for the end of 2023, that's been in their SEP projections. As he moves into this December meeting, it's going to be trickier for him to credibly threaten hikes. And so then the question is, how do you keep kind of that hawkish tone in order to continue to ensure that financial conditions are sufficiently tight that you get the slowing in the economy you desire? And frankly, I think the way he does it is exactly as you suggested, and that's he pushes back softly, at least, on the market's expectations that there's going to be multiple cuts. including several in the first half of next year. And I think Jay Powell is going to be loath to talk about rate cuts in his press conference tomorrow.
Yeah, I'm sure he will be. I am curious about how he's going to reference some of the economic data that we've gotten since the last meeting. And I want to get your take on it, too, because people sort of look at that data, at least, that labor market report from last week and a couple other data points that we've gotten. Now they're saying, OK, the soft landing is back. Goldilocks is back here. What is the picture, in your view, that has been painted out of the data that we know now?
Well, in the spirit of full disclosure, I remain on team recession. But even recognizing that, when I see the recent data, on balance, it's broadly in line with what a soft landing would suggest. I think the trend that we've seen in inflation is that it's moved down. The economy has slowed maybe a notch. The labor market has eased maybe a notch. But only not by a notch. The overall performance remains pretty solid. But I think the key question in thinking about the economy and in thinking about the trajectory of Fed policy is going forward, is the disinflation process, is getting from 3.5 on core PCE down to 2, likely to be similar to or different than what occurred as we moved from 5.5% to 3.5% on core PCE.
Yeah.
And my feeling is that this is going to be more about domestic developments, more about services inflation, and more about the labor market, and will require the labor market to loosen and ultimately recession. And that's why I continue to be part of team recession, even though this is a finely balanced set of arguments right now.
Right. You talk about that disinflation process and the nuances and the different drivers. How much of that is lost in the dot plot, which will also be released? The new statement of economic projections will come out tomorrow, and everyone's going to go through it and attach all kinds of significance to it. Was it meant to have that kind of significance, the dot plot?
I think you're right. What does the dot plot really give us? It gives us a snapshot of where the FOMC thinks perhaps rates will be at the end of the year. And specifically, it will tell us where they're thinking rates may be at the end of 2024. But what's going to be important, I think, in Powell's communication is his discussion of the path of rates next year, given his assumptions on the economy. Your broader question about the dot plot and was it intended to be so central, I think that the Fed developed it the way it did, which is, with some ambiguities and with it not being too detailed, which in this instance I think is creating some challenges for the Fed, precisely in an effort to avoid it being too central and dominating all the other discussions. And that is the trade-off. The more specific the dot plot were to become, the more it would dominate thinking and discussions and force the Fed's hand going forward.
Last question to you, Nathan. If Powell had to choose between hawkish hold, dovish hold, and just neutral hold, which do you think he's aiming for here?
I'm gonna continue to say he'd prefer hawkish hold, because I think he wants to keep pressure on financial conditions and ensure that financial conditions remain sufficiently tight to facilitate the disinflation process that he wants. But to be very clear, we can debate is a neutral hold or hawkish hold, but certainly at all costs, I think he wants to avoid a dovish hold.
All right, Nathan, always great to catch up with you. Great insights as always. Nathan Sheets over at Citi, a bit of a preview of what we might hear potentially from Jay Powell and company tomorrow. Of course, we'll have full coverage with team surveillance kicking things off tomorrow afternoon ahead of that meeting. All right, coming up here on The Close, we do have a focus right now on the White House, where President Joe Biden and Ukrainian President Volodymyr Zelensky are set to hold a joint press conference. We will bring you that as soon as it happens. This is Bloomberg.
This is the close on Bloomberg. Is the bond rally doomed to fizzle out? Some of the most accurate bond forecasters of 2023 are now saying that the strong year-end rally will not stretch into 2024. For some insight and perspective, we're joined now by Ira Jersey. He is Bloomberg Intelligence Chief U.S. Interest Rate Strategist. So, Ira, there's clearly a range of views on whether the U.S. economy makes a soft landing, a softish landing, or a hard landing. We're just talking to Nathan Sheets of Citi, who says he is on team recession, although not a hardcore recession. Yet, when you look at market pricing, most traders believe a bond rally will happen. How does that work across all those different economic scenarios?
Well, I think there's a lot of different pieces to what you just said, and certainly we've had a very significant, bull rally in the Treasury market over the last 6-7 weeks, and because of that, will it fizzle out in the near term? I think that that's very possible, particularly if Jay Powell tomorrow is a little bit more on the hawkish side than dovish. So if it's another hawkish pause, or he stays relatively neutral, then you could certainly see, I think, Treasury traders and Treasury investors kind of sit on their hands and sit pat. So it's not unusual to have these large moves, 80, 90, 100 basis point moves in the Treasury market, and then have consolidation over a matter of months before you get more data, another Fed meeting that ultimately moves the market out of that range.
Why is it that traders don't believe the Fed when it keeps hammering on about how it wants to keep rates higher for longer?
Yeah, that's an interesting question. I think a big part of that is risk management, right? So the risk is that the next move is going to be a cut. It's just a matter of when and how aggressive that will be. And there's this narrative out there, I think, that the economy maybe isn't as good, and it seems like the market often extrapolates from one or two data points and then just draws a straight line and says we're going to keep going in that direction for forever. And obviously that's never the case, right? There's always bounces and counter trends within that. So the market does think that the Fed's going to be more dovish than I certainly think they're going to be. Pricing in 114 basis points or so of cuts over the course of the next year. And will we see them? Potentially, but my base case scenario is that we're going to see less than that. But that's also what makes markets, right? Yeah. So there's certainly people that think the Fed's going to do nothing next year. Other people think they're going to cut 200 basis points.
Does the bond market, though, still have that power? I mean, we always think back to the original taper tantrum, and then I guess the taper tantrum redux in 2018 here. And I'm just wondering, have things changed so much? And more importantly, has there become so much dispersion in that Treasury space where bond investors aren't going to have as much sway over the Fed?
Well, I think the Fed doesn't necessarily do what the bond market is priced, and we've seen that before, right? They did that even in the summer of 2022 when they hiked interest rates 75 basis points over the course of 4 meetings instead of only the 50 basis point hikes that were being priced into the market. So the Federal Reserve can control interest rates. That's what they do, right? They can control those very short-term interest rates, and I think that if in fact, the Federal Reserve isn't going to cut or doesn't think it's going to cut 100 basis points or more next year, then Jay Powell has the ability to push back against that.
Does it matter, though, that right now we are looking at rates pretty much across the curve that aren't all that different, if you will, here? I mean, we're at 4.7 on a 2-year and I think 4.2 or something on the longer end of the curve. That's not a huge differential, and which seems to me to suggest that there's a little bit more symbiosis in the bond market than maybe what it seems.
Well, you're not 100 basis points inverted between the 2-year and the 10-year anymore like you were. We're closer to 50 basis points now. But that's still suggesting that the market thinks that the Federal Reserve at some point is going to be very aggressive in their cutting of interest rates. So that's one reason why the back end of the curve, so 10-year, 30-year yields are lower than front-end yields. And that's something that I think can persist for a long period of time and maybe even get a little worse if the Fed doesn't deliver what the market's pricing. So if the Federal Reserve doesn't cut interest rates in March, or makes it very clear over the next 2 meetings that it's not going to, then you can wind up seeing 2-year yields back up another 15, 20 basis points and be closer to 5% than where they are today. And that actually makes them an attractive investment option for some people. But at the same time, it's not necessarily going to make you a lot of money now if you go long 2-year notes.
So, Ira, as we prepare for the FOMC announcement at 2 p.m. tomorrow, and of course the news conference at 2:30, what has the most potential to surprise the market tomorrow?
Yeah, I think the biggest surprise would be if Jay Powell was exceptionally dovish or hawkish. If he really leaned against the cuts in particular, I think you could see a pretty decent sell-off in the market. And that goes to what we were talking about, the idea that this rally can pause, and you have, my fellow strategists at a couple of houses think that we can wind up at 4.5% by the end of the year. That's not impossible. I think 435, 440 is probably more likely, but you can wind up having, basically staying in a range from where we are now to, call it 4.4% on 10-year Treasury yields. So I think though he has to be hawkish, lean against the cuts that are priced in, and you're just going to see volatility in the rates market if he does that.
All right, Ira, always wonderful to catch up with you. Ira Jersey over at Bloomberg Intelligence. A closer look here at the potential market reactions to some of the potential moves by the Fed going forward. We await that press conference tomorrow at 2:30 p.m. Eastern Time. Meanwhile, we await right now in Washington a press conference with President Joe Biden of the United States and Volodymyr Zelensky of Ukraine. They are due to speak any moment now. We will bring you that as soon as it happens. Stick with us. This is Bloomberg.